Good morning. Good morning. Can everybody hear me? No. I think the batteries did. Nope. There we go. Good morning. Hey, Stephen, will you see if they can get new batteries for this? Or TV land people who are running the TV? Because I don't like to stand behind the podium very much. So the batteries did. Could be. Training's over. Time to go home. Okay. I know. Okay, so for those of you who were here yesterday, thank you for coming back. We didn't scare you off. My name is Randa McCauley. I'm one of the team leads, part of the training team. Stephen is back there. Krista is running a little late, but you'll see her in a little bit. And then we've got some of our agency staff is back here as well. So feel free to stop and ask us questions if you need to. So we are going to start with a little bit of housekeeping. Actually, before that, we do have to remember that we have people joining us in virtually. And for the virtual people, if you're having technical difficulties before, call the number. There is a chat box in the Zoom meeting for you to ask questions so that we can answer them throughout. If you have issues or compliance questions after training, not compliance questions, training questions, reach out to rentaltrainings@nchfa.com. Virtually and in person. Thank you. All right, give me a second. I'm going to switch. Can you hear me? Yes. Oh, that's way loud. Thank you. Thank you so much. Okay, so you have to be in class all day long. You have to attend virtually all day long in order to get credit for the class. If you only attend for an hour, sorry, you're not going to get your certificate. And we do get a report for those virtual on how much you actually attended. Some housekeeping rules. There are restrooms pretty much on every hallway. We will break around 10:30 for a break. We'll have lunch a couple doors down, and then we will have an afternoon break. Please make sure that you silence your phones. Make sure that we are limiting conversations. It's really hard to focus when there's a whole lot of extra noise happening. And we really want everybody to enjoy the training and everybody to get the best out of it. So if you do have to take a phone call, we know that things do happen. Please step out and away from the door. And again, please limit working during the training. Even the tapping of your keyboard keys can affect somebody else's ability to focus and learn on what's happening. Certificates, we will email the surveys out 7 days after the training. So if you have not gotten your survey by next Friday, please reach out to Rental Training so we can figure out why you haven't gotten the survey. In order to get your certificate and to get credit for being here, you have to actually complete the survey. So there is a final step that you have to hit submit on the survey in order to get your certificate, okay? So the first thing that we're going to talk about is just hot topics and important reminders. Again, if you were here yesterday, this is just a refresh for those who were not here. First of all, disclaimer, we know that information changes daily. So some of the information in the slides, new guidance may have come out since we created those. One big change is for trainings. Next year, we are going to have fewer in-person trainings. We're only going to do one in the eastern part of the state, one in the western part of the state, but we will offer 3 Raleigh locations. 2 of those will be virtual options. And then we are going to be rolling out a new RCRS training for next year. We don't quite know what that's going to look like yet. Hopefully a combination of in-person and virtual options. And then, of course, our new training dates and everything will be out the first week of January, but just know we will no longer have 2 in the western part of the state and 2 in the eastern part of the state. So you will get 1 chance on each side of the state to attend training in person. A big change is we have done away with that 15-day grace period after a final report is submitted. So this is for both file audits and physical inspections. We send you the compliance results letter. That is the exact same. You have the 30 days to respond. And then we send you the final report. In the past, you had a 15-day grace period to kind of send documentation for things that you may have forgotten or that we didn't count as corrected or things like that before we issued 8823s to the IRS. This year, there is no grace period of 15 days. The final report is final. So anything that was missed, you'll have to do a compliance resolution packet. Okay. And we can report to the IRS the day after the final report was submitted. Now, we are not that quick. However, things will get submitted far quicker this year since we're not having to keep those open for longer. The fee schedules, this changed in October of last year. So hopefully everybody is aware of these changes by now. The utility allowance fee went from $150 to $250. And all of these fees, if the actual amount due is not paid, we will send the checks back. We will not process until the full payment is here. Ownership change fees, those increased both for full tax credit property and those with an agency loan. Partnership change fees, there didn't used to be a fee. Same with management company change fees. There didn't used to be a fee, and now there is. And it is important to remember that if your change includes multiple items on the list, you have to pay for each thing that you're changing. So if you have sold a property and changed the management fee or management company and assuming the loan or modifying the loan that's already existing on the property, all 3 things need to be included in your payment fee. I will say that unfortunately, all of these fees right now still have to be a paper check. We are very hopeful that the utility allowance fee is going to be done online in the very near future. But still the other change fees are still a paper check. So be on the lookout. The utility allowance fee will hopefully be able to be accepted online in the very near future. I'm not giving you a date though. So report cards have already been sent out. Every management company that is on the approved management company list gets a report card at the beginning of the year for the year prior. And in order for new allocations in order for you to be selected to manage any new allocations, whether it's rehabs or new construction, you have to be on the approved management company list. And so in order to do that, we grade you on a list of things. And those report cards, again, have already been out. They're already finalized. We did remove some management companies from the approved list, and you are off for a year before you have to ask to be reevaluated to be put back on. Some of the things that we look for are tax credit experience. So you have to, the management company has to manage at least 1 similar project. So if you're trying to get a new allocation, then you have to have at least 1 property in North Carolina that's still in the IRS compliance period. You have to be registered with the Secretary of State. You have to be in compliance with the KEY program. This includes requesting KEY payments. This includes requesting vacancies, putting everything in the vacancy and referral. And then Louise sends out updates as to where you are. And a lot of times the reports are now available in our CRS for you to update or look at that throughout the year. We look at your reporting in our CRS. You have to report at least 85% or more timely. And again, those reports that are in our CRS now, they only are looking at what has been entered. So if you have not entered the data, our CRS doesn't know that the data needs to be there, so it doesn't realize it's late. So if you then enter it, it might skew your percentage because you have entered late data. So if you forget a whole month or a whole property for a little while, our CRS doesn't know that that data is supposed to be there. So it can't calculate it because it doesn't know to calculate it. So missing information, we have seen properties where I don't know how an entire property got missed, but an entire property got missed for the entire year. Okay. So it's very important that you as a management company are running these reports, pulling your property activity report to make sure that on a monthly basis that you have entered all of the data. So when this property got entered, they went from that 95% accuracy all the way down to 75% because you missed potentially, 100 unit events, depending on how big the property is, with every recert, every move in, every move out. And so now that our CRS knows that that data is supposed to be calculated and every single one of them was late, what is that going to do? It's going to make your number go way down, way fast, right? So it's important not just to run the report of what your percentage is of timely, but also running that property activity report against what the property has done for the month to make sure all of the unit events are actually entered. Okay. Training requirements, you guys are doing great. You've already been here to the advanced compliance. Those of you that came yesterday, you got 2 out of the 3 done already. Stephen does a great job sending out an email to everybody on the approved management company list in August and September if they are missing the mark and need to attend one of the trainings before the end of the year. Tax credit designation, somebody in a supervisor role has to have one. Uncorrected noncompliance is another big thing. If you have uncorrected noncompliance at the end of the year, that is grounds for removal off of the approved management company list. So it is very important that you are printing out and reviewing those final reports to make sure that everything is corrected. And if everything is not corrected, creating the compliance resolution packets to correct those items. Right now, there is not an easy report to run. We can run those reports upon request, but there isn't a report for you to run for the entire portfolio for open noncompliance. But if you go into a property and attempt to create a compliance resolution packet and you can't, then you don't have any open noncompliance. But if you can create a compliance resolution packet, then you have open noncompliance. Super easy for you, even on the site level, if you have access to RCRS, to see if you have open items, is if you can create a compliance resolution packet for that property, there's open noncompliance. If you get that circle, the no circle that says you can't, then you're good to go. Rent increase compliance, implementing a rent increase on an existing property without agency approval is grounds for removal off of the approved management company list. So if you have to get approval for a rent increase and you implement without that approval, then you are removed from the approved management company list and you are off for the year. There's no correction for that. You can't go backwards. There is a change in the rent increase policy, which we'll talk a little bit more about later. But if you got an allocation of federal tax credits in 2025, moving forward, every property will have to get a rent increase approval, not just those with an agency loan like it was in the past. For the report cards, if you have questions about the KEY program, you're going to reach out to Louise Gardner. If you have questions about RCRS, you're going to reach out to Compliance Help. If you have questions about training, you're going to reach out to Stephen. If you have questions on the rent increase compliance, you'll reach out to Krista. And I apparently forgot to update this slide. If you have questions about the report cards in general, reach out to Chelsea. And her email is in the front of the book. The key payment standards, these were released in late 2025. You don't have to make any updates in RCRS. It does it for you automatically. All of the worksheets for the new payment standards are available online. And there were no changes from tier 1, tier 2, everything from 2024, from 2025 moved over to 2026. So whatever worksheet you are using in 2025, you will continue to use in 2026. A big change is if you are using your third-party software to upload the data into RCRS versus manually entering the data, we retired the ability to be able to use NAMA 6 and 7. So your software has to be using NAMA 8.0 in order to do that transmittal. So if you use your third-party software to create an XML file, and then you're uploading that XML file into RCRS so that it does it automatically. If you're getting an error, it's probably because you're not using 8.0. So make sure that your third-party software is using 8.0. If you didn't even know that was a possibility, ask your third-party software how to do that, because it's a whole lot easier. We did release our home policy effective January 1st. There are some big changes, which we'll talk about more in detail, but just know that that policy is available. It's on our website. And when we talk about home, we are talking about home funds that are distributed through our agency. We are not talking about the home funds that are given to you by a local municipality like the city of Raleigh or the city of Durham, the city of Charlotte, the city of Greensboro, counties. We are not talking about any of those. I cannot tell you how to monitor or how they monitor those home funds. I can't tell you how to stay in compliance with those home funds because I didn't give them to you. So when we talk about home funds and the home policy, we are only talking about the home funds that are given to you by North Carolina Housing Finance Agency. So questions on hot topics? Any of the stuff that I just went over now? Stephen, do we have any questions in TV world? No, perfect. So we're going to talk about loan documents. These are crucial to know how to monitor your property. Oh, you said no. I know. We need you in our team. Yep. Snooze, you lose. Let's go.
Is there always going to be a difference between from the National Housing Trust Fund and 30%?
I am not understanding the question. National Housing Trust Fund can only be a 30% set aside, but not every 30% set aside is National Housing Trust Funds.
And they say that we are doing a lease up and noticed that there was a slight difference in the income limits.
Correct. Because National Housing Trust Fund uses a completely different income and rent limit chart than a regular 30% unit. So all National Housing Trust Funds are 30% units. Not all 30% units are National Housing Trust Funds.
So there's always going to be a difference.
Potentially.
Okay.
And we'll talk more about rent and income limits later. So back to documents. You want to make sure that you read over all of the loan documents for your property so that you actually understand what is required for your property. Every property is built different. Every property has different loan documents. Every document is, again, different. So make sure that you know and understand what is required for every property specifically. Some of the ones that we're going to talk about are the LURA, which also includes the extended use agreement, the deed restrictions, commitment letters, loan agreements, and the deed of trust. Some of them are far more important than others. Some important verbiage to remember is affordable to and occupied by. Affordable to is going to talk about rent. Affordable means I can afford to pay. Okay, I can afford to pay it. Occupied by, that's going to talk about income. That's going to be that they income qualify in order to occupy the unit. Okay, so again, affordable means I can afford to pay. talking about rent. Occupied, you're talking about occupancy, that they qualify to live there. In the LURA is agreement between the owner and developer and the government official, which would be us. They are restrictions placed on the property for that tax credit, for those tax credits that you got. If you happen to have a property that doesn't have tax credits and they're only loans that are at the property, you're not going to have the LURA. You're just going to have deed restrictions and loan agreements. But the LURA is specifically for tax credits. It's going to specify like the minimum set aside that the owner chose, whether it's a 40-60, a 20% at 50, or average income. It also notes any additional set asides, like the QAP restrictions at 30%, whether we have given you an RPP loan, whether that's a housing trust fund, National Housing Trust Fund, or home. It's also going to include the extended use agreement, which is that additional 15 years that you have to stay in compliance. But a big thing is also, it's very important to realize that that LURA follows the property for the full 30 years, even if you sell it. So that new owner, that new investor, all of that, the LURA goes with the property. It has nothing to do with the original owner. Okay. So the LURA goes with the property for the full 30 years. In the deed restrictions, obviously it's going to give you a description of the property, the length of the affordability period for that RPP loan. Okay. Deed restrictions are given when the agency gives you an RPP loan. So that's going to be your state housing trust fund, your national housing trust fund, your home loans. You don't have deed restrictions if we have given you state tax credits in the form of a loan. So the deed restrictions come for anything that is an RPP loan, and the affordability period has nothing to do with the compliance period. They are two totally separate things. They do run congruently a lot, but they are completely separate. So you could still be out of the compliance, the original 15-year compliance period for the IRS, and still under the affordability period of these funds. Did you have a question? Yeah. The state. So the question is, what do the deed restrictions cover? Home, National Housing Trust Fund, and then we have state housing trust funds. And those just say HTF. There's not an N in front of it. And there are some other smaller ones, but those are the big ones. We've got some old funding that doesn't exist anymore that still fall under the RPP loan, but the big ones are the HTF, NHTF, and home. But also in the deed restrictions, it's going to be the monitoring requirements. You have questions in TV land.
From the report card, how they get to see the list of approved management companies other than their own.
If the developer, if they choose to go in the RTC app, there really isn't a published list. It's not public knowledge. You can't look at your neighbor and your best friend and find out if they're on the list or not. But the owner and developer, when they're putting in new allocations, they can only choose somebody on the approved management company list.
If they have a question, they can contact
Correct.
Chelsea and not us.
Yep. I am not the keeper of the list.
The joy of not being here today.
I am not the keeper of the list. Yes, sir. I'm sorry, I didn't hear the first part of your question. Yes, so the question is, are there times that there are loans that are not federal? And that's absolutely, the state housing trust funds are not federal. And that'll just say HTF. So the national ones that are federal will have an N in front of them. And so a lot of times when we talk about home, we're also talking about National Housing Trust Fund, and they have the N in front of them. If it doesn't have an N in front of it, that is a state funding and not a federal funding. And again, there are some other small ones that have been retired that you'll see a whole bunch of letters in the system that are older, but those are the most common current ones. If you have a specific question about a funding source, let me know during the break and I will let you know what it is. So again, back to the deed restrictions, they talk about the compliance monitoring requirements, the income targeting, the initially approved rents, which are super important, because if your rents were approved under the 50% limit, they will always be under the 50% limit. If like there are things that you can't go up from those those rent limits that are initially approved. It's also going to tell you that you have to get approval from the agency. Fair housing requirements, affirmative marketing requirements. Other important documents, again, they're important, but not as important. Your tax requirements are going to be in the deed of trust. Your commitment letters, this is what the owner and developer have committed with the agency that they're going to do. There is going to be some preliminary commitment and maybe 1, 2, 3, 4, or 5 final commitment letters. I don't know why there are so many final commitment letters sometimes, but the loan agreements are another important document. These are going to talk about your financial audit requirements, your reserve requirements, what is required to remain in those accounts as minimum balances, whether or not you have to get approval to take money from those accounts, and insurance requirements. And again, those loan agreements are in play until the loan is what? Paid off. Okay, so even if we've got some properties where the tax credit compliance period is well after the 30 years, but they still owe us money. So what are we doing? We're still monitoring for the loan requirements, even though they no longer have to abide by the affordability period or the tax credit period. We have extended the loan, so the property still has to abide by all of these. Okay, but they all work together. So we're going to talk about an example where things matter. So we're going to build Sea Glass Meadows. Isn't it pretty? It's not real. 78 units. It's a family property. It's got 4 buildings and it's got tax credits and national housing trust funds. So our LURA, it says that we've got a minimum set aside, and it looks like the owner picked 40% at 60, right? It's our most common. Average income is definitely coming up there, but 40-60 is the most common, or has been for years. They are not a nonprofit set aside, doesn't really matter in this situation, and then we also have Section 5 that talks about the state housing policy restrictions. So according to the QAP, we have to have 25% of our units at 30% AMI, okay? So 40 at 60 means 30 of those 78 units. I did the math for you. You're welcome. 25% of the property, which is 20 units, have to be at 30% rent and income. And so we know that we've got 40%, and we see our words that we needed occupied by. This one says rent restricted, which is great when they use that. And then down here we have affordable to and occupied by. So we know that both of them are rent and income. It is very possible that they are income restricted and not rent restricted. You're not going to see it the other way around. They're not going to be rent restricted and not income, but you can see income restricted without a rent restriction attached. And then we've got our deed restrictions. Our deed restrictions here, they say that we have our affordable rents. We've got 40% of the units, which is 32, have to be at 50% rent restricted. And then we've got our National Housing Trust Fund down here that says 17 of the units are subject to the National Housing Trust Fund, which we know is 30%. So we've got at least 17 units at 30. We learned earlier that we actually have more than that with the QAP requirements, but we have 17 National Housing Trust Fund units. So what we've learned is 100% based on the LURA is at 60%, because we saw that they opted for the 40-60, but 100% of the property is affordable. So 78 units are rent and income restricted at 60%, correct? So then we learned that the QAP, we have 25% of the units, which is 20 units, have to be rent and income restricted at 30%. And we learned that 40% of the property, which is 32 units, are only income restricted. If we go back to the deed restrictions, it didn't say anything about affordable to, it just said occupied by. So they are only income restricted at 50%. And then the remaining of the units are 60%. And then we've got our National Housing Trust Fund, which is 27, it says 27 or 17 units are rent restricted at the National Housing Trust Fund level. So we need 17 units for National Housing Trust Funds. Is that in addition to 20 units at 30%, or can they be the same units? You can be the same units, right? Do all of these units, we need 32 units at 50. Do we need 32 in addition to these 37? I mean, these 20. Sorry, our 17 get eaten by the 20. So we've got 20 at 30, right? Do we need an additional 32 units? How many more units do we need? We need at least 12 50% units, correct? Now, can they have more? Yes. So we've got 20 units and they eat these 17. We don't need 17 more. So we need at least 20 because it's the bigger number. We need 20 units income and rent restricted at 30%. These 32 eat up these 20, but not all the way. We need 12 more, right? So we need at least 12 at 50. And so now we're at 32 units counted, right? 12 of them are at 50%, 20 of them are at 30. How many more are left for the 60? How many? 46? I didn't math it, so I hope you're right. So, so we've got 46 units at 60, 12 at 50, and 20 at 30, okay? But they all have to work together. You have to work from the bottom up, right? And you have to realize that some of your units are going to count as multiple things. Questions? Do we have questions in TV land? No. Krista is here. Are you ready? Okay. She was running a little late and I didn't know if she was gonna be ready to do this section. Epic.
So I was going to be an hour early. The traffic is just as bad today as it was yesterday. It was awful going home too. So what are you going to tell people when they ask you about our NCHFA trainings? They're great. They're wonderful. You got to be there. You learn so much. It's nothing scary about it. It's not. So who needs a rent increase approval? So all properties with active agency loans are required to gain prior approval for all proposed rent increases. So you need to know what type of property you are and make sure that you're getting those approvals so that you don't have to go back and get a post approval, so that you don't have to go back and refund residents. And also, if you don't get that approval and you were supposed to, you can become off of the management list. So if the agency loan has been paid off early, the agency still requires approval of rent increases until the affordability period has ended. The initial rent structures must be entered into RCRS before any rent increases can be submitted for review. Management enters the final rents from the development stage into RCRS as the initial rent structure once the permanent financing has been completed. So beginning in 2024, any state tax credits that were allocated that year going forward are going to need NCHFA approval, even if they never did have to have that in the past. And in 2025 allocations and going forward, they're going to require the NCHFA approval, regardless of the funding sources, again, even if they never had to in the past. So not like a property that you've been managing for 10 years, that's not what we're talking about. We're talking about those that get the allocations and are getting ready to be built. So the funding types requiring the rent increase approval would be the Integrated Supportive Housing Program, the TCAP loan, the RPP, PLP, SHP, state tax credits in 2024 allocations and going forward. And in 2025 going forward, it's going to be all properties. So you're always going to refer to your specific loan documents if clarification is needed. If you increase the rent before you're issued your 8609 from development, you can have really bad repercussions. So please make sure that you're reaching out to development if you have not had those 8609s issued, to ask them if you need a permission to raise it, get that permission. When development staff is reviewing the final cost cert, they will discover if you have increased rents without approval. And there are consequences that are determined by development, and you could lose the ability to request future rent increases. So that would be very detrimental to your property if development said, yeah, you can't increase your rents for X amount of years. So regardless of the funding type, agency approval is required in the 2025 QAP for any type of loans or any type of properties. This is repeated because it's very, very important. It's something that a lot of owners and management companies are not used to. So that January 1, 2026, there was a new rent increase policy. The proposed budget is compared to the actual expenses. You have to, after the adjustments are made, if you have a 1.15 debt coverage ratio or $1,000 per unit, we will not allow you to increase more than $25 a unit. You have to show a need. Failure to get rent increase required approval. Implementing the rent increases without agency approval will result in management or ownership to not be in good standing with the agency and non-compliance of the project. And it will show up on your management company report card. If you have a property and it's layered with RD or HUD, you know how you get those letters from RD and HUD and you have your budget and everything on there. If you need to request a rent approval, then you're going to send me that letter from RD or HUD, and then you'll go ahead and enter it into RCRS. I will go ahead and upload that document and just go in and approve those rents. So what are some common reasons why rent increases are returned? Your utility allowance is not current, or the most current approved UA is not used. So when you go in to do your rent increase, look at what the UA is and make sure that it's the correct one, whatever is the current. If you had it approved in October of 2025 and it's for $100, make sure you change that in your documents that you're uploading, that you are not leaving it at last year's rate. The effective date is not a minimum of 60 days from the submission or the resubmission. So if you submit it, it has to be 60 days from that date. If there are issues with it, whether you asked for too high of a rent increase or the UA was not right and it gets returned to you, then the resubmission date is the new date that you're going to use to calculate that 60 days. If you have not entered the current financials, make sure you go and check those financials before you send it to me. Because if you don't, I'm going to return it to you. And then you've got to, again, calculate that 60 days after you get ready to do it. And that could set you back some asking for that date to have it increased. Make sure that you're meeting your required set-asides. Don't ask for too large of an increase. And don't ask for more than one increase in a 12-month period. So if you see this under your rent structure after you enter your new rent, then you are not meeting a minimum set aside. There should be no numbers in red. Even if your property is exempt from a rent increase oversight, you cannot go over the rent income limits. So if you go into the rent structure here, this says that the property is exempt. So you know, oh, I don't have to go in and ask, but you still need to look at what those limits are because you still can't go over them. This is instructions and helpful tips to ensure your submission will meet all required criteria. How do you go into RCRS? And you will also know that in NCHFA.com on our website, there are RCRS slides in there that will help you to go in and do a number of things. And if you need additional help, reach out to me. So for reserve requests, there are two types. There's replacement reserves and there's operating reserves. All properties with an active agency loan are required to gain approval prior to withdrawing funds from the reserve account. The required documents for both types will be found in the loan documents for the property. All requests to withdraw funds are submitted via RCRS. Again, you can find the directions on our agency website. All requests, I'm sorry. If reserve accounts are underfunded, we may deny future requests under the accounts until the accounts are funded properly. Failure to get approval before withdrawals. If you withdraw money from either reserve account without agency approval, it may result in management or ownership to not be in good standing with the agency and noncompliance for the project. There are rent-up reserves as well. They are used for initial operating costs during the lease-up. Withdrawals do not need agency approval. And when loan converts, excess funds must be transferred to the replacement reserves. The replacement reserves are used for capital improvements and replacement items, not repairs. So monthly deposits are made. If requesting for reimbursement of expenses, management must provide the actual invoices. If you are requesting for prior approval, management must provide 2 to 3 comparable bids. Make sure that you include the recent, good Lord, I can't even speak today after that traffic. Well, most recent bank statement, the trial balance, and all of your invoices or the bids. Double check them once you scan them in to make sure they are legible. Make sure that you have included a spreadsheet, especially if you have 5 or more invoices. It just makes it easier. I can go in and I can see, okay, this invoice is for this unit number, which is for this. And sometimes you might have more items on the invoice than what's approved for withdrawal. And so if you know you're only going to be using $1,200 out of that $1,500 invoice, you're going to write that in. It just makes it easier and quicker. The easier and quicker that I can go through those, the quicker that you get them back, which is the goal. So typically, North Carolina Housing Finance Agency requires $250 per unit per year for new construction and $350 per unit per year for rehabs, with deposits escalating by 4%. This is not enough to fund your long-term needs. So routine replacement items such as carpet, flooring may be submitted quarterly or annually. The minimum balance required in the replacement reserve account is going to equal to 24 months of the required deposits. If the balance is less than the required amount, we may not allow a withdrawal, even if the item would normally be reserve eligible. Exceptions may be made on a case-by-case basis for properties in extreme adverse financial situations. So replacement reserves that are typically approved: an appliance replacement, bathtub or shower, a roof replacement, whole gutter downspout for the building, HVAC replacement, repaving, resurfacing, seal coating, parking lot or sidewalk. If you are doing the entire property's range queens, fire stops, the door, sink, faucet, toilet, window replacements, only if you are replacing at least 10 to 15% of the property. extensive plumbing sanitary system repairs, repainting the exterior of the building, water heater replacement, or the flooring replacement. And replacement reserves that are typically not approved would be the interior painting of the unit, the blinds, appliance repairs, repairs for your HVAC unit, bed bug or other pest control treatments, landscaping, water extractions, pressure washing, or items that would be covered by insurance. So again, just remember the difference between replacement and repair. The operating reserve request is funded prior to the loan closing. It's used for operating deficits during the times of economic hardship, such as high vacancies. The withdrawals do require our approval. The account must be restored to the required balance prior to any distributions or payments to the owners or investors. And to request a withdrawal from the operating reserve account, you're going to submit a letter explaining the request along with the most recent reserve bank statement, the most recent trial balance, proof or the detailed explanation of the operating deficit, and a list of the outstanding accounts payables. You should go into those payables though and make sure, is there anything that you can ask out of the reserve replacement before you ask for the operating? The property must be running at a deficit to be eligible. The replacement reserve items are not eligible. The mortgage payments, monthly reserve payments, management fees are not eligible and will be taken out of the calculation to determine the deficit. Common requests include annual taxes, insurance deductibles, and unforeseen expenses. So common reasons why the reserve requests are returned: attempting to submit or open more than one request at a time, requesting the reimbursement for the non-eligible items. There is no summary page for a large request showing the breakdown of the submitted request. Unit or building numbers are not included either or on the invoice or the cover sheet. So if you don't have a cover sheet, I'm going to go to the invoice. I'm going to look, you may have either handwritten in or the vendor may have typed it in underneath the address line. I will look for it first. And if I can't find it, it's either going to be returned to you or I'll send you an email trying to find out exactly which unit that went for. And I go back and look and make sure, did you include this same invoice or for the same item on a previous request? And should it be being requested again and replaced again so soon? Sometimes people forget to attach the invoices, or they have the wrong property, the wrong documents are not legible or anything like that. So make sure you double check before you click that button to submit it to me. Sometimes the bank statements do not match the trial balance. If there's more than one account, we need the bank statements for all the accounts. So you may have 3 different accounts from 3 different banks, and then the trial balance says it's supposed to be 150,000, but you only gave me a bank statement for 50. I have to have all of it. Make sure that your invoices are no more than 12 months old. If they are, again, they will be returned to you, or the account is underfunded. There is a minimum that everybody has to maintain. So the things you need to remember is if you're submitting for a prior approval, you must include 2 or 3 comparable bids. If you're submitting for reimbursement, you must include the actual invoice, not a quote. For invoices over 12 months old, they will not be accepted. Include the most recent trial balance and bank statement for the reserve accounts. So if you're submitting something today, don't provide me something for January or December. It has to be current. And it takes up to 30 days for the agency staff to review and approve all reserve requests. And if it gets returned to you, remember that that clock starts ticking again. Preference is to enter 1 per quarter or semi-annually. And again, we're asking that you have a cover sheet listing all the items included. Don't forget the unit numbers and or the building numbers. If you have multiple buildings and they each have the same unit numbers, make sure that you're including that. So tips to getting the reserve request processed quickly, which is everybody's goal. You're going to only request items that are eligible. Go in and look at each thing that you're processing. Is it eligible or not before you send it? Make sure that you're checking what has been scanned and uploaded. Is it legible? Is it correct? Is there a cover sheet that includes the vendor, the date of the invoice number, the items, the unit building number, and the amount requested? Is the invoice less than 12 months old? And do not include copies of things that are not needed. When you are submitting your invoices in that scan, I do not need copies of the checks. I do not need copies of the bank statements. I only want the invoices. So having a well-submitted request will make the process smoother and in the end, a quicker return to you. This is the instructions for RCRS if you need them. And again, additional instructions are included on our website. And if you need any additional help with reserves, you can reach out to me. The audited financials, the deadline is coming up and it's going to come up quick. We're going to blink and it's going to be here. So the audited financials are required to be submitted through the RCRS annually for projects with agency funding. For the fiscal year ending December 31st, they're going to be due by May 1st. For any other fiscal year ending, they are due 120 days after that date. Failure to submit the audited financials may result in management ownership not being in good standing with the agency and noncompliance for the project. Remember your due dates. And again, if you are required to ask for a rent increase and you have not submitted these financials, it will be returned to you. So please double check that first before you submit for the rent increase. You're going to upload a PDF version of the audited financial into RCRS. You should have your comparative year schedules, including the reserve accounts activity. If consolidated, must contain property-specific schedules. Enter your data from the audited financial into RCRS. All available information must be entered. Findings noted by the auditor must be addressed with a letter or memo noting all actions taken to correct. Instructions for the data entry of the audits can be found on the agency website. And why do your financials get returned? Sometimes when completing the data entry, using numbers from another source that do not match the audit, submitting balance sheets and other printouts in place of the audit, late submissions, you submitted the audit but did not complete the data entry in RCRS, or not including the asset management fees, investor fees in the data entry because they haven't been paid out. Any fees listed on the audit that are charged to that year must be included even if the fee is accrued. And if you have any questions with the financial audits, you're going to reach out to Chelsea. Insurance requirements. The information that is required is included on the agency website. Make sure that we are notified of all claims. We have a new policy and a new email address to report those. It's insuranceclaims@nchfa.com. If you have a down unit, you're going to also notify us of that down unit to the same insuranceclaims@nchfa.com. Just put a little note in there that you are not going to send it off to insurance. So a down unit is described as a unit where damages include but are not limited to weather-related, accidental, or intentional damage, system failure, etc. So the following documentation is required to be included with the incident: a description of the event, including the time and date, buildings and unit numbers affected, individuals involved, including the name and contact information, and any third-party reports such as police, fire, insurance. Notify us via that website and just put a note in there that you're not going to be reporting it to insurance. And insurance reminders: promptly pay or cause to be paid all premiums when due on all insurance policies and not less than 15 days prior to the expiration dates of such policies. Provide to the lender evidence satisfactory to lender reflecting that all required insurance is current and in force. During the term of the loan, the agency may require modifications to existing insurance or require additional insurance at its reasonable direction. And you can find more information about our insurance on our website. If you have an RPP property, you have certain documents that need to be approved. The lease approval is required prior to the loan closing. Upload the lease along with appropriate lease addendums and RCRS to match the funding sources applicable to the property. We need the TC lease addendum, the home lease addendum, and remember that all units must float, or the National Housing Trust Fund addendum if you have that type of funding. And remember, all units must float. The agency will not verify or review the actual lease going forward since the addendums are required. We still encourage you to have your lease reviewed by an attorney. And if you have any questions, you can send those by email to Dorian. The tenant selection plan is required prior to the loan closing. You're going to upload that via RCRS and include your checklist. Refer to the agency website for the current requirement and important data. And Heidi Holt used to be the person over our tenant selection plans, but it's now Amber Burgess, and you'll be able to find her information in the book, in the front pages of the book. If you change management companies, ownership, you must update it. And remember we haven't talked about the affirmative fair housing property. However, that is 5 years. Every 5 years, it needs to be updated. The affirmative fair housing marketing plan is required prior to loan closing. You're going to upload that via RCRS. Be sure to include the applicable worksheets and other supporting documentation as required by the plan. And if you have any questions, you're going to send that to Dorian. And again, if you change management companies, if you change ownership, or every 5 years, you have to update your plan. The tenant participation plan is only required if you're a Chodo property. It's required prior to the loan closing. Refer to your agency website for current requirements. If you have questions, you're going to reach out to Dorian for that as well. And the grievance procedures is also only required if you're a Chodo property. And again, questions, reach out to Dorian. And if you have changes or updates, you need to resubmit. Are there any questions? Break. So if you can come back in by, is it 10:15? 10:15.
Is everybody ready to get started? We're going to let everybody file in for a second before we get started because the TV land can't hear us. If everybody could come in and sit and do it quietly so TV land can hear what I am saying. All right. We are going to talk about the home program. And again, am I talking about the city home program? No, I am talking about the home program that we administer, that we monitor for. Home funds are given by lots of different allocating agencies. I am only talking about the ones that the agency allocates. And we're going to talk about requirements, income requirements, rent requirements, utility allowances, income and assets, and we are going to talk about the new home final rule in conjunction with all of that. So the home program, it is, what does it stand for? Home. It doesn't stand for anything. It stands for home. It is the Home Investment Partnership Program is the legal, what you're going to find if you actually Google the program. If you Google home program, you're going to go through a rabbit hole and not find all of the things. But it is a major federal grant from HUD and to different states and localities to fund affordable housing. It is different from tax credits. It's different from National Housing Trust funds, although they do mirror each other. So when I talk about home funds, I am also referring to National Housing Trust funds. Okay. There is no guidelines for National Housing Trust funds. Our National Housing Trust Fund stuff, we monitor, we mirror what we do for home for those funds as well. Obviously, the income and rent limits have a different chart, but when we talk about like how we calculate income and how we do those things, we are talking about National Housing Trust funds as well. So HUD is the funding source. HUD gives states and local local governments what we call PJs, participating jurisdictions. The HUD gives states and local PJs the funds to then allocate out and monitor for. The funds can be used for rental housing, buying, building, or renovating, home ownership. They allow funds to help families buy or build their first homes. And home funds can also be used as TBRA or tenant-based rental assistance, which are portable vouchers. I am not talking about home ownership today. I am not talking about the TBRA funds today. We are only talking about rental housing. Okay. I don't work in our home ownership program, so I can't tell you what they do. Although we do use home funds for home ownership opportunities. So our home policy, HUD published the home final rule, the new home final rule in January of last year. Most revisions became effective April of 2025. There are some tenant protection stuff that is still in limbo, so we won't talk about those today. But all participating jurisdictions are supposed to come into compliance with the home final rule by April of this year. We implemented effective January. Again, some of those tenant protections and green building initiatives are not 100% settled with HUD. We are not implementing that kind of thing yet. Our home policy is effective for all home properties. It does not matter when you got your home funds. If you got them in 1983, and for some reason you're still abiding, but obviously they're gone by now, the affordability period is over. But if you are still in your affordability period and you are in year 29, the new home policy, the way our home agreements are written, we can implement the home policy for all programs, not just the new ones. There are some of the new home final rule stuff that pertains to development that we will not talk about today that are only for new projects going forward, because obviously you can't go backwards with cost per unit and things like that. But when we're talking about the compliance part, everything in the home policy is for every home property, not just the new ones. Some states will differ. So if you are doing things in different states and they've implemented home, you just need to make sure whether or not it refers to new or old stuff. We will update the lease addendum later once the tenant protections are, yes, ma'am. So the question is if home match is the same as home, and the answer is yes. Well, there is a but. So the home program is administered by HUD. When you see home match, the PJs are supposed to match a certain amount of those home funds. So those are the funds that were not given by HUD. Those were agency funds to match the HUD allocation. And so, yes, they're still home funds, but when you see home match, those are not federal home funds. Those are state home funds. And so there is a little bit of wiggle room if things are wonky, but we still follow home as home. So if you see home DR, those are disaster relief home funds. If you see home match, are those the only three? There might be another weird one. But home, if you see the word home, we treat all of our home funds exactly the same. But if you see home match, those are actually state home funds and not from the federal government. But it's too hard to differentiate. You have this kind of home and you have this kind of home. So if you see home, home is home. We do require our home units to float. So if you have any source of home funds on your property, you want to treat every unit like a home unit. Even if you only have 10 home units, you are going to treat 100% of the property as if it were to have home. You're only going to designate 10 of them as home units. And the reason for this is we talked big yesterday about layered funding and how sometimes things don't work and you have to be out of compliance with one program and in compliance with another. Having your home units being able to float allows you to manipulate later and still be in compliance, okay? So when we talk about home, we have two different rent limits. We have low home and high home. In projects with 5 or more home designated units, at least 20% of them have to be occupied by households who have annual incomes that are less than 50. Those are considered low home. Low home limits, income limits are typically below the tax credit 60% AMI limits, okay? When the household income exceeds that low home limit at recert, they are now considered a high home limit. So in the tax credit world, you don't move them up a designation until they hit that 140%. In the home world, they are at 51%. They're now considered a high home unit and not a low home unit. So there's not that 140% threshold like there is in the tax credit world. The second they go over 1 penny of that 50% limit, they are now a high home unit. So in 100% unit complex, that is 100% home, I'm making math really easy today. How many units are considered low home? 20. Man, y'all are good. Who are we talking to? So high home units must be occupied by households who have an annual income of 80% or less of the area median income. Can we go up to 80 in a regular 40/60 tax credit? Nope. So you're going to be capped at that 60% limit. Now, if you have an average income property, you can go up to that 80% likely, if long as they're still below the 80%, if you have 80% units at an average income, because average income allows you to go up to 80%. Now, if you've picked 70% as your max, can you go up to that 80? Nope. So you're still capped at whatever your highest set aside is on an average income property. But again, you have to be mindful because home, do they use the same income limits as tax credits? Nope. Is the 80% home the same as 80% tax credit? Nope. Can home be higher? Yep. And then you'd be capped at that tax credit 80% limit. So you have to be really mindful about what income limits you are using when you have home properties. So your high home limits, they may exceed the tax credit depending on other in-place restrictions. When your household Yeah, HHH throws me off when it's supposed to be household versus high home. So when your household income exceeds high home at 80% at recert, what do you have to do? Adjusted gross income. Who wants to do that? Nobody. So what are you going to do if they're not 100% home? You're going to swap, and you're going to make a different household because you've treated everybody the same. You're going to treat a different household as your home unit, and you're now going to count this 80% person who went over the high home limit as a normal unit, so that you don't have to do that 30% of the adjusted gross income, because nobody wants to do that. Yes.
And redo the tick.
Not the tick. You're just going to swap the status in our CRS. On your tick, yes, because you're done it at recert. So your tick you're not going to have to change it because you've created a new one at their recert. But you are going to have to uncheck the home box in our CRS when you upload. And you will have to do that manually more than likely, because your software is going to forget to do it. So if you do swap status for any reason, just make sure that you go into our CRS and make sure that box has also been checked in our CRS. And then check the box that you have counted it for. Okay. Again, if less than 100%, we are floating, you're going to swap status instead of doing that adjusted gross income. Now, if you are 100% home, you don't get that luxury, unfortunately, and you have to do the adjusted gross income. There's no way out. Okay. So let's talk about the income limits. Home income limits are not held harmless. Being held harmless means they can't decrease. Home can decrease, and they do decrease. Which means you need to be, we'll talk about it in the rent section more, but you need to be mindful if your rent and income limits have decreased in your county, because you might have to adjust rents. Okay. They typically match the Section 8 income limits. However, you have to wait till the CPD releases the rent and income limits for home to make them effective for the home units, even though they're the same. You have to wait for the CPD. We don't use the 30 and 60% limits on the home chart for tax credit properties. They are completely different. Those are for informational purposes only. And again, we upload all of the income and rent limits into our CRS to make it super easy for you. So some rent reminders. Low home, 20% of the home units must be at 50%, which is the very low income. The rent is limited to the lesser of the low home or the fair market rent. The rents can exceed the low home rents if the unit is a tax credit unit and has rents that are not greater. So we used to home the low home rents that were lower than your tax credit rents, you would be capped at. You'd have to go with the home. You can now use the tax credit rents if you've got the tax credit layer. Obviously, if you don't have tax credit layer, you can't. Rents must be approved if you have home funds. Again, if your income limits decreased on your home property and you are even close to the rent limits, you need to make sure that your rents did not go down and you don't have to decrease your rents. We see it every year when the rent and income limits are released, where you have some counties that have been decreased and you have a property that is at the rent limit and they now have to decrease their rents because they were at the rent limits and there was a decrease, because home rent and income limits are not held harmless. They can decrease. And we aren't going to tell you that you have to do it. You have to monitor that for yourself. We have a question in TV land. Okay.
The first is a comment.
Oh.
They can hear someone is clicking on their tablet or computer.
Tell Sandy to get off our training. I'm just kidding.
No, in the room
Yes.
here.
Yeah.
Yes. So The second is if a property is 100% home and when the head of household income exceeds the high home and the head of household is required to pay 30% of the adjusted income for rent, can the rent exceed the rent that has been approved by NCHFA?
It has to, that's the one and only time that it has to. Or not have to, but can. That is the one and only time that you can charge higher than what the approved rent is if you are doing the adjusted gross for somebody who has exceeded the high home. Because they are paying 30% of their income, so it is still affordable to them. So that is the one and only time that if you are required to get approval for rents, that you are charging more than what the agency has approved. You're still charging less than the tax credit max rents because you're a tax credit property. If you're a tax credit property, you still have to be mindful of that tax credit limit. But if we have approved $900 for that 2-bedroom apartment and you have a household and you are 100% home and you cannot swap designations and you have a household that went over the 80% limit and their 30% of their adjusted gross income says that they would pay $950, you can charge that $950, even though we have maxed you at $900. As long as, again, the tax credit limit is higher, you can charge that $950 because they are only paying 30% of their income, so it is affordable to them. It is the one and only time you can charge more than what we approve, and only on that one household. Does that make sense? Any other questions in TV land? Perfect. Again, rent limits, they're not held harmless. They can decrease. You're only going to use same as the income limits. Their income and rents are the same. So, rent limits. How to calculate if the rent is below the maximum home rent limit. In the past, we've taken the resident paid rent plus rental assistance plus resident paid utilities plus any mandatory fees, and that is how we have come up with gross rent. Everybody remember that? Can we all jump for joy that the home final rule, you no longer have to count the rental assistance? So it now matches what you do with tax credits. What you get from the PHA on behalf of the resident no longer counts towards the gross rent for the unit. It is very good. That is very good. It was really bad back in the past when you'd have to look at your PHA and say, I am so sorry. I cannot accept what you're willing to pay me. Another reason that it was very important to have your units float, because you would never put sometimes you didn't have a choice, but you would really try not to put a Section 8 household in a home unit because you didn't want to have to go to the PHA and say, I am so sorry. Can you keep your money? Because I can't take it. So now you don't have to. Now that piece of the puzzle is gone. So student rules, assistance shall not be provided to any individual who is enrolled as a student. Does home care about full-time and part-time, or just one? They care about both, right? It doesn't matter what kind of student you are, full-time or part-time, unless they meet one of the following criteria. So they have to be at least 24, a veteran of the Army, married, they have to have a dependent in the household, disabled, and was receiving Section 8 as of 2025 or 2005, not 2025. They just have to meet one of the rules, just like tax credits. They don't have to meet all of the exceptions. They just have to meet one of them. Utility allowances. Back in the day, you couldn't use PHA utility allowance for home. You can now. If the UA increases, it can cause the home limits to be exceeded and you might have to reduce your rents. So again, be mindful of every year when you are updating your utility allowances. If you are super close to the rent limits. And heaven forbid you're in a county where the utilities went up and the rents went down. It happens every year. So the PHA utility allowance obviously must be used for Section 8 vouchers. The final rule allows for home to also use that PHA utility allowance. So if you wanted to use the higher PHA utility allowance for 100% of your units and get a super easy UA, you can. And just a reminder, cable and broadband cannot be used in your utility allowance calculation. So for home, for income determinations, this is another really big change. We talked about it a little bit yesterday, but the new home final rule, basically, HUD says, hey, you already calculate income a certain way. We're going to say you don't have to do it a second way. You can match whatever you were already doing. So if you have a home and HUD property, a home and tax credit, a home and RD, home is saying do whatever you were doing for that other agency. So a home and tax credit property, you no longer have to do homes separate. You can do them exactly the same, which means HOTMA applies and you can do that 2 pay stubs versus 2 full months worth of source documentation. Can we say yay? Because that's another huge win. Now, if you are home only, which again is a very small percentage of our portfolio, you are still doing 2 months worth of source documentation. You are still verifying all assets because you don't have another that you are matching. There is no tax credit, there is no HUD, there is no RD to follow suit with. So you have to go by what home says. Does that make sense? If you have tax credit, RD, or home, then HUD is saying, hey, don't do it a second way, do what you're already doing. If you don't have tax credit, HUD, or RD, and you have home, then you have to follow the 2 months worth of source documentation and verifying in assets because there isn't anything to match. This also allows for the documentation, the income documentation from other governmental public assistance, AKA Safe Harbor. Home allows you to use Safe Harbor, which is basically sending 1 sheet of paper. How many? One verification for all income and all assets on the property if the household receives other governmental public assistance. Home, we're talking about home. Food stamps, WIC, if they have a Section 8 voucher, if they get child care subsidy. What am I missing? If they get TANF or Work First, what am I missing? Did I get them? Most of them? Those are the big ones, right? If they get any of those, if the government helps them financially on a regular basis, monthly basis is generally how all of them work. And they have to recertify every 6 to 12 months with those agencies. You can send that agency 1 form and say, hey, what did you calculate their income to be? And then what do you put on the tick? The exact number that they put on that form. Okay. Now, there's some guardrails in place. We all know that people get a little crazy with getting assistance sometimes, right? You're going to send them a form and it's going to say, I have household A that has 4 people in the household. There's 2 adults and 2 children. And they send back a form that says, yep, we have Jane Doe gets WIC, but there are 5 people in her household. But you only have 4 people in her household. Can you use that form? Nope. Households don't match. Okay. Now, you have a household that has 4 people on the application, 1 adult, 3 kids. Food stamp sends you an application that says, yeah, there's 4 people, 2 adults, 2 kids. Can you use it? Nope, not the same household. Okay. Yes, ma'am. Yes. So the question is, can you get from a PHA, if they have a Section 8 voucher, you can absolutely send it to Section 8 and say, hey, what did you calculate their income as? They're going to send you this form back and they're going to say, this is how I calculated. That's the best one because they calculate it the same, very similarly. Obviously, they do adjusted, tax credit doesn't do adjusted. Is that person still going to qualify for your household? Yes, they're still going to qualify for your household. So you are going to use whatever number. If they say that household of 4 makes $35,176, you are writing $35,176. Are you verifying any of it? Are you verifying the assets that they said they had? No. One piece of paper. One verification to track down. 0 calculations to do. I have a question in TV land.
Only need 2 paycheck stubs. Do we still have to do a year-to-date calculation?
Yes. If you are getting paycheck stubs, you are going to calculate 2 ways. That has never changed and will never change. Do you get the same exact number every time you calculate? No. Now, sometimes I'm a state employee. My paycheck doesn't change. It's the same every month. If you were a monthly salaried employee, it's the same. And it's going to be the same whether you calculate year to date or monthly or average or whatever. Is that the normal? No. So that has not changed. Only the number of paychecks have changed. We always want to see your year-to-date calculation. And so if you've gotten pay stubs, you're gonna average them out. If you've gotten a verification of employment, you're still gonna do the year-to-date calculation because they gave you that information. You're still gonna do the average $15 at 25 hours a week. You're still going to do 2 calculations. You are still going to take the highest of the 2 calculations. Home doesn't change that. Home is only saying, hey, if you have another, you can get less paychecks. Okay. Big note, you cannot use the safe harbor for your targeting program, your key assistance. Anybody want to guess why? Does that verification from food stamps tell you if it's a disability source of income? Nope. Do you have to have a disability source of income to qualify for that program? Yep. So you can't use it because it doesn't give you the information that you need to make sure that that household qualifies. Okay. Questions? Yes, ma'am. I can see it brewing. You, perfect. Catch me during the break. She's refusing to ask the question because she doesn't want to ask a stupid question for those in TV land that want to know why I was talking to the air. Perfect. Any other questions? We good? Everybody excited about the new home final rule? Everybody excited about the safe harbor? We need y'all to be excited about safe harbor. Hey, my compliance people back there, would you rather them use 1 piece of paper? 1 piece of paper? Yep. Uh-huh. All right, I think it's Steven's turn.
All right. My foot went to sleep while while Randa was talking. So now I'm walking funny. I might need to qualify for one of those targeting households. Can you help me with that, Lamar? Can I get in the Clive program? Oh, my leg went to sleep. Well, at least I didn't go to sleep. That would have been bad. Okay. What are we going to do next? All right, so we're going to talk about the tax credit requirements on a federal and state level. But first, let's do a little exercise. I need 4 volunteers to come up front, and they have to be in the classroom. They can't be in virtual land because you need to be here. Oh, I thought she's going on a telephone call. I thought you were volunteering to come up here. I'm sorry. Ooh, my leg done. This is really bad. My friend from Asset Living is going to come up. Who else would like to come up? What about my friend from Keystone that I met earlier? You look like you knew I was going to call your name. You felt it. I need one more. Tanya, will it help you pay attention if you come up here? It won't? Okay. Okay. What about Lacey? Would you like to come up here? You're paying attention, so. Where's Jeff? Tanya said that if you work with her and you're in TV land, to quit emailing her. She's trying to pay attention and she doesn't want to get called out again. Ain't that right, Lacey? Ooh. Now my leg is cramping, just falling apart. They said when you turn 40, it's all downhill. And I just turned 50, so I don't know what this is. But good gracious.
Gained momentum. Your snowball is large.
You get one chopstick. One chopstick. One chopstick. Okay. And you get some cereal. No, we're not having sushi. It stinks. I'm allergic to fish. Here's your bowl of cereal. So your job, you're going to have to open up your cereal and you're going to try to act like you're eating cereal.
With only one stick.
Yes. No, because I did that in the last training and they cheated and my little exercise didn't work. No, it's not. It's circumventing the. So go ahead, eat. And then you're going to take your cereal and you're going to put it in your cup that's up here. So you take no, you can't dump it. You got to use like she's doing. See, this is the tools such as training for compliance. So if you don't have the right tools to do the job you're set out to do, it makes it more difficult, correct? You can still do it. It's just taking her longer, right? But if we gave her, and we have all ladies up here, I just noticed that. So I apologize for the lack of diversity. But if you take and you had chopsticks, a full set.
Now we're talking here. Good thing I like sushi.
Well, good gracious. I can't get that. Can you get that for me? I can't bend down. No, you can't dump it in there. That's cheating. Non-compliance. It's non-compliance. That's fraud. You're back when you're doing something like that, you're backdating documents and stuff like that. You're not following the program guidelines. But if you have a full set, look how much faster you can do your work with your full set. See? Well, you know, I didn't want to bring sushi in here. I didn't have enough to share with everybody. But see, you can do it a lot easier if you have the correct tools. Everybody? And a natural skill set. You could tell who eats sushi and who doesn't. You love it? We're having it for lunch today. Okay. Does it taste like sushi? But if you attend trainings with the agency, national trainings, your management company, you have no, we're done. But you can eat the cereal if you would like. Is it not your favorite? Yeah, yes, you can. Or you can leave it up here and I'll get it during the break. But the demonstration with this is if you have the correct tools, you can do your job a lot more efficiently. Everyone would agree? So if you're able to use HOTMA and you use HOTMA and you understand it, it makes your job a lot easier. So you're able to be successful at whatever you're doing within your position. So what role does the agency play? Our agency, we administer federal and state housing programs. So we know we get money from the tax credit program automatically. And then we also get money from the federal government funding for housing, such as the National Housing Trust Fund and the home funding that we receive. And then we get state housing money as well through the WELP program, which of course, if you're a developer, you know right now, and you put an application in earlier, there is no WELP money this year because we don't have a budget. So we get to skip that this year. That's going to make deals and applications a lot more difficult. So if you're a developer, you know that's really important to you right now. We allocate those tax credits. We give that money out to the developers. We are partners in affordable housing. We are partners with building affordable housing, with rehabs of affordable housing, preservation of affordable housing, and historic landmarks and buildings. Some of you might work. I think someone said yesterday they worked at Print Mills in Greensboro. So we do rehab such as that. We provide technical assistance for our compliance programs, such as our training. If you have issues with using RCRS, you can email compliance help. And then if you have questions later after you leave today, we have an email address, the rental trainings that you can send questions to, or either you can reach out to us directly. A lot of you will wait until we have an inspection and you ask us questions during the inspection time. That's fine. We rather, like I said yesterday, help you ahead of time before you make a mistake than help you fix a mistake. That's a lot easier because some mistakes can't be fixed. If it's something where you can, like it's a home unit and the home units float, that's why we do that in North Carolina. Or if you've selected income averaging for the property, those units have to float as well. We're able to help you figure out what we need to do to get that unit back in compliance, because that's a benefit for us as the state, but it's also a benefit for you, the management company and the owner, because it helps you stay in compliance. And then we do report to the IRS. We do have to do that. We like to report to the IRS on the 8823 that you are out of compliance, but we most like to report that you're back in compliance. Because that is the ultimate goal, is to keep everyone in compliance. Our qualified action plan, our QAP, is listed on our agency website. We publish this annually. It does change. We have public hearings. We've had a couple this year already. If you attend the Affordable Housing Conference in Raleigh at the end of the year, I think this year it's in October. There will be a workshop in there where you can make comments about that QAP, some of the requirements that are in it, whether you like it, whether you don't like it. And our staff will take that under consideration for the next QAP. It addresses state-specific housing goals. Every county in our state has different housing needs, has different issues that they're facing, populations that they're trying to serve. So our QAP will be reflective of that. It establishes the minimum threshold requirements, such as if you're doing a rehab, you have to spend so much money per unit to qualify for that funding. It establishes the selection criteria. One of the big things in that is, what if there's a tie? How do we break the ties with the application? All that information is in the QAP. And then we limit the amount of credits awarded projects and development entities. So if you're an owner, I think you can only submit 3 applications per year. With that, this represents some of the changes that you can see within the QAP. It's very important that you know what's in your QAP for your particular property. So if you know the year that you received your allocation of credits, then you can go and you can look at some of the things on our website that the owner agreed to take under consideration. These are even important when you're in the extended use period. So when you look at this, you see supportive services were required, were mandatory, starting in 1996, and it went all the way through 2002. The targeting program, if you receive credits, allocation of credits between 2001 and before, there wasn't any targeting requirements for our properties. So there are some of you that you received an application prior to 2001, you don't have targeting units at your property like some of the other properties do. It's because of the year that the property received its allocation of credits. And so you see that in 2002, we started giving optional points. Points are very valuable in this process because the application process is so competitive. And then in 2004, going forward, we made it mandatory for all projects that you have to set 10% of your units aside for targeting households. And then the KEY program came into play as well in 2004. So we have the targeting program and we have the key assistance. The targeting program is separate than the key assistance. The targeting program is the reservation for those units for those particular individuals that need their services. The key is the money that pays their rent. So if you live at or you manage a property that has 100% rental assistance, do you have key money at your property? But you have targeting units though. So instead of DHS making those payments, your rental assistance providers such as Rural Development or HUD is going to make those payments for you. But this is just a breakdown on how it is involved and some of the differences between the years. Supportive services requirements. If your plan was originally required, then you must continue to follow the approved service plan. The plan is not relevant or needs to be updated to reflect the current activities. Submit a copy of services plans to the agency for approval. So at one time, these services were available, but they're no longer being offered or you can't find someone to offer these services. Then you can reach out to leadership within the agency, such as one of the team leaders or Susan, and start the process to see what you could do different with supportive services. The documentation, notebooks, flyers, sign-in sheets, calendars, you got to document it if you're supposed to have supportive services. Note, do not confuse supportive services with supportive development housing requirements. That is totally different. This is talking about services that are offered, such as wellness visits. You have somebody that works there and they help your residents find medical, housing, not housing because they already have somewhere to live, but they help them find food if they have insecurities about that. Some of them will offer pantries and stuff like that. The supportive development housing is totally different. It is like our shelters, our group homes and facilities such as that. And that's a whole separate training and a whole separate area that Susan Collinger and Tanya works with. So if you have any questions about those, you can see her and she can assist you with those. The targeting program and key rental assistance, again, this talks about the targeting program, talks about the key rental assistance. They're two separate things. What the property management company is responsible for. We do have training that's available throughout the state and even here in the McKimmon Center, and we offer it virtually. And that training can be signed up just like you signed up for this particular class as well. And so they have another one coming up at the end of the year here in Raleigh. and it'll be virtual, but then they also have one in New Bern that's coming up, and I believe they have one in the Statesville coming up. So you can register for that. Good training, especially if you have targeting, help you understand it. Very important that you understand the requirements of the targeting program if you have that at your property, because it can affect your report card and you being on the approved management company status. So RCRS software, each management company has an RCRS administrator who can assign contact roles, tags, and reset your user passwords. So you no longer have to email Tanya and ask her to reset a password. The administrator for your particular property that's been given that role in RCRS can reset the passwords for you. And then they can make all these changes as well. So that's important to know. Ensure the management or contacts are correct in RCRS, because that's who we're reaching out to. That's who the report cards are going to and notifications are going to. And if they're no longer correct, then we're sending out information and no one's getting it, and you don't find out until the end of the year until you're in trouble that you've got an issue. So make sure that's corrected. Ensure your contact roles are updated for each property staff as your staff changes. There's a person that should be listed for the physical inspection contact, file review contact, key contact, primary compliance, project specific, your on-site operations, and your financial contract. So we know who to contact without having to email this person, and hopefully they email that. If I'm scheduling an inspection, I'm going to email you. You don't respond because this isn't correct, I'm going to start emailing the owner and the president of your company. And I can guarantee you I'll get a response real quick. So let's go ahead and take care of that and keep that updated for our properties. If yours aren't correct, or you don't know what to do, or you just got access to RCRS because you're a new management company in North Carolina, we have a YouTube video on our playlist. It's on YouTube. You can search NCHFA Asset Management, and there's a group of videos. There's one about assigning roles, and there's one about creating your contacts. Your on-site contact person should be the person that works at the property. It shouldn't be somebody 5 states away. If that is not updated, we will cite state noncompliance. We don't want just the email address. There needs to be a phone number. We've noticed that some people have started putting just the email address and not a phone number. If we're trying to locate your property because GPS is giving us an issue, I can email somebody, but they're not going to tell me quick enough that that needs to be where I need to be going. And also, if you're far away and you're not there at the property, you're not going to know that how to tell me to get to the property when I'm sitting in the Lowe's parking lot. So we want to make sure that this information is updated. Submitting documents for file audits, utility allowance, tenant selection plans, your responses for file and your physical inspections, targeted documents, forms, rent increase, reserve requests, they need to be uploaded in RCRS. Do not email those to the person that you're working with. They need to be uploaded. There are some documents that we can upload in RCRS. So if you send me the tenant selection plan and I upload it on our side in RCRS, it will show the document there, but it doesn't fall in our queue for us to go and work it, and we're not able to move it forward or approve it. So it's important that you do that. I can go in and impersonate you, and we're not supposed to do that. I can't go in and click the buttons for you. I can, but they frown on that. And I have 2 little dogs that need dog food and nice clothes, like little children and stuff. So I have to follow this policy as well. So this protects, you're sending confidential information in most cases. So if you're responding to a file review and you miss something such as an asset, you send that to me, you're sending some of their financial information from the bank, enough information that somebody could use. And we don't want that. Our system is very vulnerable, being a state agency, for people contacting you. Think about the owners. that put in an application, they submit it to us their financial information. The residents are submitting their paycheck stubs and those sort of things, and we don't want people to have access. So if you do that through RCRS, it's more secure. Our email is pretty good and secure. Our IT does a great job of training with us and sending us suspicious emails to see if we're paying attention. And if you don't, then you get a little slap on the hand and you have to watch a video for like 5 minutes. Yes, we get on the bad report card list, and eventually then you have to have a conversation with Sandy, and I don't know about that, but I don't want to figure it out and have to come back and tell you about those conversations. So make sure you submit that, protect our tenants' data, your information as well. So don't email it. We do not accept things in a Dropbox or zip folders either. So don't send us the email with those items. We do have some resources available right now. Randa did a presentation at SAMA, I think it was last year. Was it last year? At SAMA, with some of the new information in it, some of the things that people have trouble with. If you go to our website and you click on Rental Housing Partners, and you click on Forms, and you click on Compliance Manual and Training Resources, you will see the last one is the RCRS overview presentation. That's a PowerPoint presentation, and she covers a lot of information with RCRS. So make sure you take advantage of that. That's free information. It's good for new site staff to take a look at it. If you want to use it and train your staff in a meeting or something like that, that's fine as well. You also notice that this is where our compliance manual is. So if you need that, that's the state compliance manual that we have for North Carolina. And then all of these trainings that we do that are virtually from Raleigh, once we're finished, we put a copy of the training book that you received through the link or the paper copy. We have it where you can download it on your desktop if you wanted to do that. So it's available here. So we've already submitted for this training the books, so they should be up within a couple of weeks for you to look at. And then we'll have the videos on our playlist as well. So if somebody missed it or you need to remember something, you can't find your book, you needed extra books, you're able to get that from there. We wanted to make that available to you. The role of the IRS in affordable housing. The IRS performs 3 major functions. That's the tax return processing. Everyone likes that if you get a refund. If you don't, you hate today because today is the 15th. And so you know what today is, right? So if you don't get it done by the end of the day, you're late. You're going to have non-compliance with the IRS. That's going to be bad. They provide taxpayer services and enforcement. So there's one that takes the money. When you're out of compliance, we don't recapture any money back to the agency from the owner. It's the IRS that makes that decision. So we just tell them, this is what happened. They corrected it. You're good. They didn't correct it. That's when they reach out to the owner and start saying, hey, you had some non-compliance. We might need to have a talk about you needing to give us some money back. And that never goes well. So they establish the tax credit program requirements and provide program reference materials. They regulate and enforce the requirements of Section 42 of the tax credit program. And this enforcement involves recapture of credits due to non-compliance, but we don't have to worry about that because everyone that receives non-compliance is going to correct it, correct? Right, and that's what we want to help you do, get it right. Types of credit developments, we have new construction, we have rehabilitation of existing units, and we have acquisition and rehab. Our agency requires a set dollar amount of unit rehab costs that can be found in the QAP. We talked about that. I believe Krista mentioned that as well. I think it's like 300 and something. Oh, that's the reserve, but that's in the QAP as well. Credits are allocated based on the competitive application process. States are required to allocate at least 10% of their annual credits to projects sponsored by nonprofits. So some of you might work with some nonprofits. 10% of the money that we received has to go toward them. And again, this is where you would locate the allocation plan on our website: rental housing partners, developers, qualified action plan. And you can see here that you can drop down and look at all the QAPs from previous years if you need to see something from the year you were allocated from. This is the 8609 form. It's issued by our agency. It's that officially allocates the low-income housing tax credits to a building. It's required to claim the tax credits on the owner's tax return. And the key point is no valid 8609 means you get no tax credit claim. So the owner or the investors don't get their money, and that would be very bad. How are some comment documents here are some common documents that we ask for before we will issue your 8609s. We ask for your certificate of legal existence, investor certification letter, your operational agreement, promissory note, list of the contractors and subcontractors, statements of compliance for all that are listed from your contractors. We ask for your current utility allowance and your documentation, your current tax bills and insurance bills, your Energy Star certification, and then your letter from the Public Housing Authority. And then the owner has to have compliance training certification. So if you're an owner, you have to attend Compliance 101 or Advanced within the past 12 months in order to get your 8609s. So you need to make sure you stay on top of that if you're an owner and developer, because you want to make sure that you get your training in before you're going to be asking for these 8609s. Most developers who develop every year with us go ahead and take care of that with the early training at the beginning of the year like this one, so they can stay ready to go. The 8609 Part 1 is completed by the agency, the building identification, your bid number, your credit allocation amount, the placed in service date, and whether you're a 9% deal or a 4% deal. You need to verify Part 1 for accuracy when you receive it. Part 2 is completed by the owner. This is where you're going to, on line 8B, select your multiple building project selection. And then 10A is your minimum set-aside election. 10B is your deep rent skew election, if applicable. 10C is whether or not you chose income averaging. 11 is your applicable fraction method. And 12 is your first year credit portion. And remember that your elections are irrevocable. You can't go back and change it once you signed it and you submitted it and filed it with your tax return. Multiple bin selection 8B, a check yes on the line will result in each building being considered a separate project under Section 42. You select the minimum set aside on the form. The minimum set aside again is irrevocable. It must be maintained. It's tested at the end of the year. And the set aside meets across the property or building based on the election made on 8B of the 8609. It's important that you, as the property staff, know, because this could have an impact on how you handle your transfers for your tenants. If it's a separate building, then they move from building A to building B. That means that you'll do a move out and you'll do a new move in into that, if that's how you selected it on this form. And then if you moving in building A and they're moving to another unit in building A, then you would do a move out. But if they selected that all the buildings are one, then you can move back and forth and just do a transfer. So that's very important. You have to choose one of the set-asides, the 2050 test, 20% of the units is greater than 50%. The 4060 test, the 40% of units. Average income test of designated units, and then individual units can be up to 80% AMI. And then failure to meet the minimum set aside is a loss of all credits. So it's very important if you have income averaging or average income that you get your set asides correct based on the 8609. And then once you start moving people in. Your line 11 is the applicable fraction. It's determined the amount of credits that can be claimed. And this is how you calculate it, or the lesser of. Unit fraction is the floor space fraction. How many of you have your HCCP in the room? How many of you had to remember having to do these calculations? You're like, whew, I don't want to do that again. How many of you had to calculate since you had your HCCP? If you do, you're an important person. So pat yourself on the back. So your first year credit rule is on line 12. These are the credits are prorated in the first year based on when the units became qualified, the average applicable fraction. Your common methods are monthly averaging year-to-end occupancy. Errors here can lead to our IRS recapture, so make sure you get it. So it's very important, as you can see, that your site staff know what's on the 8609 so they can know how to do their job. There's no secrets on it. It doesn't tell you how much the owner makes a year, what their net worth is, or anything like that. So we shouldn't be, we might not want the tenants to see it, but it's, it's okay for your site staff to see it. And it would help them out, especially the 8609 and the QAPs. Owner files the 8609 form with the 8586. You must retain the original 8609, the election documentation, and the compliance record. The retention period is at least 6 years after the due date, and it's extended if non-compliance is found. Compliance ties to the 8609. The 8609 drives your unit designations, your rent limits, your income limits, and your extended use agreement enforcement. Remember that non-compliance is reported on the form 8823. So we like the 8609 because it's the money form, as Sandy used to say. The 8823 is the take money back form. Some common areas to avoid is missing your filing deadlines, incorrect minimum set-aside election, mismatch between the 8609 elections and your regulatory agreements, incorrect applicable fraction, and then poor record retention. Again, review the 8609s immediately. Involve the tax credit syndicator and the CPA. Align the property operations with the elections. Train on-site staff on unit designations, and then conduct annual internal compliance reviews, as well as the reviews that we conduct or your syndicators do as well. You have to upload these in RCRS to remain in compliance. This is where you would do this. This is for individual property. You would go to the drop-down list and select your documents. And then the very last one is the 8609. And that's where you're going to upload. Make sure before you upload, that you upload all of them for your property. So if you have 10 8609s, how many should you upload? So if you upload 9, what does that mean? There's a problem. So make sure you do that. Then make sure that they have been signed and dated by the owner. That's very important. In order to be official, they need to be signed by the owner. Credit periods and the IRS compliance period. The credit period is the first 10 years of the property that you started claiming. Sometimes they're done over 15, but most people will go ahead and take them over the 10-year period. Don't confuse that with the compliance period, which is 15 years. That does not change. It's the first 15 years of the affordability period. The property must comply with the regulations or be subject to recapture. This is when we report to the IRS all of your non-compliance, either physical inspections or file reviews or anything else that you do that's not in compliance, such as you submitted your AOC late. And if you haven't submitted yours, it's late because they're due February the 10th every year. The credit period and the compliant period start the first year that the credits are claimed. Your extended use period, this is the additional 15-year extended use period after the compliance period. So this is the second 15 years or the last 15 years of the 30-year period. You must comply with the deed of restrictions. There is state enforcement, so there's no recapture. So again, if you're in this 15-year period here, we're not going to report anything to the IRS unless you have a fair housing complaint that you lost. Then we would need to submit that on the 8823. But that shouldn't be happening much because we're all fair housing trained, right? And we're not doing crazy things and we treat everybody the same. We're nice to everybody, all that good stuff. So then you only have state, so it stays with us. However, you still have to stay in compliance because you want to stay on that approved management company list. Right now, if you're in the compliance period, you have to have our permission. The QAP changed, was it last year? That the QAP changed that even in the extended use period, you have to get approval for a management company. It was either last year or the year before, if you placed in service or received a credit allocation, and you're in the extended use period, you have to be approved by the agency. Right now, you don't have to be on the approved management company list, but that has changed. So probably about the time we retire, that'll be, everybody has to be approved. It'll also have an impact on your owner because if that particular property, the owner will not be able to continue with their application process for tax credits. And as competitive as these deals are, they want to get this information correct and they want to meet the deadlines. So it's very important that you, even if you're in the extended use period, that you correct your noncompliance. There's also legal action that the agency can take against you as the owner that can assist you with seeing how important it is to take care of that. Early termination of the minimum 30-year period only if it's foreclosed or through the qualified contract process. And in North Carolina, we don't have the qualified contract process. So the only way you can get out is filing bankruptcy for the property. And that's not something you want to do because then you can never do business with the agency or other agencies as well. So that's not the route you want to go. The extended use compliance period, again, must fully document eligibility at move-in and the first annual research. No additional research are required unless you have a loan from the agency. So make sure you check with your deed restrictions. You must continue, even in the extended use period, to report activity in RCRS, your move-in, move-outs, AOC, affirmative fair housing, marketing plan, tenant selection plan, and so forth. In North Carolina, the student rules do not apply in the extended use period. However, you don't want to make that decision yourself. You want to check with the owner to see what their plans are in the extended use, if they plan to sell the property. Because if you sell the property and it's full of students, that's going to make it hard on the new owner, and the new owner might not be interested in having to deal with that because those students, you just can't ask them to move. You have to incentivize them. And then you have somebody like me who knows that. You're not just going to give them a $500 gift card. I'm going to ask for a whole lot of stuff because I know how important it is for me to leave. Yeah, you know, movers. I might even ask you. I've known a management company an owner that had to purchase land and a trailer for someone to get them to move out because the owner realized what was going on. So it's very important to have that conversation. And then if the owner is to say, hey, you know, I'm going to come in and I'm going to ask for a rehab. Well, you know, when you do that, you can't have the students again, so you run into those problems. So make sure that you know what your owner's plans are before you implement and allow students into the housing. Your compliance review project-wide, not building by building. And then we start with a smaller sample size when we do our monitoring. Recertifications by funding source, you can use this chart. If it's 100% tax credits, you have to do a full anniversary recertification. Then you start with the annual update of the household composition, update of the student status, and then the annual update of rents being charged. If it's mixed income, you do a full annual recert, income, everything.
And mixed income is mixed funding, right?
Yes.
Okay,
Mhm.
so on 100% tax credit, it doesn't really matter if they have market units and tax credit units, or is that not a thing?
So if they have market rate units, then they're mixed income.
Okay,
Everybody got that? So if you're 100% tax credits, but you have some few market rate units, then you're mixed income. And that is correct. You wouldn't be 100% tax credit. Thank you for pointing the obvious out that I totally missed. That was not obvious to me. And I'm the one that created this slide. See how obvious things can be? It could be so obvious that you miss it. So if you're in the extended use period and you're 100% tax credit, see how it changes? You do everything you did originally, except for you don't have to do the student status. And then if you're mixed income, you change that to where you do the full annual review every year. You're only going to do the full at first, and then you're only going to worry about the household composition and the rent being charged. And we have a question before we go to the next one or to the next section. Okay, finish this. Okay, so if you have federal tax credits with average income, this is a North Carolina policy, and we'll talk about it a little bit later, but you're going to do a full annual recert every year just because you did average income. It doesn't matter if you're 100% or if you got mixed income. We can't have mixed income at a property. You're correct, because we don't allow market rate units if you selected average income in North Carolina. If we were in Texas, they changed theirs. Oh, they started allowing it or doing what we were doing. Okay. So if you have full tax credits with average income, you have to do a 4-year full recert, income, assets, the whole 9 yards every year. And then if you have RPP funding or other agency loans, it triggers that you have to do a full AR every year. Are you ready for the question? Are y'all ready? You okay with this? Everybody good? Cut this out, tape it to your computer so you know about your property.
This is another question that we answer all the time is the research. But the question in TV land is going back to extended use for a moment. Property is at the end of the extended use period. It ends in 2029, so they've got 3 years left. They had 24 pages of findings on their most recent inspection. They're working on corrections, but their management company inherited the issues. The management company inherited the issues.
Of course.
Will they be held responsible for the non-compliance?
I would have bought another property and I would have done my due diligence. No, that's not the correct answer. No. Well, sometimes again, the obvious is so obvious you miss it. But so they're in their 29th year, I would assume, or the 30th year. They're in their 27th year, so they're almost finished with us. Everybody clap for them because they're probably going to come in for more credits. But anyway, they just had an inspection and they had how many pages? Okay, so who do y'all think that inspector was? No, don't do that. No, don't do that, because it could have been me. Or do they have to make those corrections? to meet the state requirements. So that's a lot of correcting to do. They just bought the property. So it's just, they just took it over, inherited a property with all these problems. How many of you been there? Happens to all of us. You have to make the corrections, but we will work with you. We will be kind and helpful to you. But don't wear our patience thin. Right. As long as we can see you're attempting and you're not still blaming the previous owner and management company, which is usually the case. We know it. We don't need for you to remind us of it. We just need you to start fixing the stuff. Does that help? And does that seem fair that we're going to work with you? Okay. Because it's in the extended use period and the IRS isn't involved in it, we have some time because we're not pushing a deadline to start recapture or something with the state. Can it affect the management company report card? Will we work with you? The first time or two, yes. After that, you become a habitual needing a pass or assistance, then we're not as friendly. We'll still be nice to you. Speak to you if we see you at the grocery store. I'm not going to push you out in front of a car. But we're not going to be as, but if you just happened to trip and fall, so. But we try to be helpful. We understand all of us have worked in property management before. We all have. So we know how things go. We know the game. We know the system. We know how to work it to our advantage. We know how to tell people are trying because we've practiced those same steps ourselves. But we do know that we're dealing with people and we all need help sometimes. We all make mistakes, even people in compliance. Is that all the questions in TV land? I don't care. I did. See? Thank you, thank you, thank you. Now I get to practice what I preach with being nice. And I'm trying to go back and think about everybody that I've had an inspection with this year has been nice. So, well, we'll see. We'll see. Come back next year, huh? I'm gonna have to figure this out. But come back next year and we'll tell you how part 2 of this sequel went for these people. But I'm sure we're going to work with them and we're going to be nice to them and we're going to help them. And because that's to an advantage to us as well. If we leave you out there with a lot of stuff to do, that just creates more work for us. So, I don't know about you. I'm getting older. I'm not going to say I don't want to work, but I hadn't won the lottery yet. As you know, yesterday, I didn't have enough grape clusters on my lottery ticket at lunch and I had to come back. I was about out of here. TV land again?
They had some time to think.
I shouldn't have kept talking.
They have a question about recertifications.
Okay.
And I'm assuming we're going.
When in doubt, do a full research.
Well, does NCHFA require a signed tick for self-certifying tenants? So these are your updates after the first annual
We don't tell you
recertification.
how you meet these 3 requirements of the annual update of household or the annual update of that one we do, you have to fill out that form, or the annual update of rent being charged. We've seen many things. We've seen people print the tick out of RCRS and have them sign it. We've seen them complete the recertification questionnaire. where it lists who's living in the household. So we've seen that information captured in many different ways. We don't specifically tell you what form you have to use or what you have to do. The annual student status, of course, you have to use our annual student status form, so you're going to use that. The annual update of the rent being charged, if you printed the tick on page 2, it's going to have the rent. So you satisfied that. You can kill 2 birds with 1 stone. You can do, because the tick's going to list the household and the tick's going to list the rent on page 2. If that's what you want to do. I've seen people use like a rent extension addendum at recertification, an addendum to the lease that updates what the rent is. I've seen them do that. That's fine. Ever how you recapture this information and it's communicated to the tenant, so you have something saying this is your rent, this is what you're supposed to pay every month, and this is who's living in the household as at the time of the recertification. Everybody good? All right, let's go to the next one. So reminders, 100% of the units in the project can be targeted to low-income households or a smaller percentage. The percentage is the applicable fraction and is recorded on the lower. Projects are subject to the IRS and state regulations for a 30-year or more affordability period. It prohibits eviction or termination of tenancy other than good cause. So again, you're coming in for a rehab and you've got students, terminating students because they're students and they don't qualify to live at a tax credit property. That is not good cause. You're going to have a hard time standing in front of a judge and telling them, I need to evict this person because they're trying to better themselves and go back to school. They're going to look at you and say, huh? And there are 2 types of courts. There's the criminal court that we go to, and then the court of public opinion. And sometimes you can lose far more in the court of public opinion. So just keep that in mind. And then prohibits the refusal to lease to Section 8 voucher holders based on being a voucher holder. So you can't terminate somebody's lease because they got on a Section 8, and then you can't refuse to rent to a person because they have a Section 8 voucher holder. What's the one exception? When would you tell someone that they have a Section 8 voucher and they can't live at your property? Your property has 100% rental assistance. You can't use both. Did somebody say that? I'm sorry, I missed it. Yeah, so if your property already has rental assistance, because you think about it, how many of you had an RD property with 100% rental assistance? You don't use that rental assistance for how many months they take it? Yeah, you don't want to lose your rental assistance. That would be very bad because you can't get it back. But that should be in your tenant selection policy. So whoever said tenant selection policy, you were kind of right. 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 They need to give their voucher back. And they might decide to go somewhere else because I wouldn't want to, if I had a voucher from the housing authority, I wouldn't give it up. Which is what you would have to do if you moved in 100% rental assistance property. All right. So the vacant unit rule, this is a project-based rule. It focuses on mixed income properties. Non-compliance is reported on category 11J on the 8823 form. Owner fails to make a reasonable attempt to rent low-income units before renting the market rate units. This can be documented using by your newspaper ads, your marketing resources, and such. Why would you want to rent a market rate unit before you rented a 30% unit? You get more money, you charge higher rent for a market rate unit. So would you be tempted to rent your market rate units before you rented your low income units? Yeah, because you're making more money. You want to make sure your paycheck's there for the deposit. So that's what that's talking about. The 140% rule. This is when a household's income exceeds the 140% of the first income limit at recertification, the unit is over income, and the available unit rule must be followed. Non-compliance is reported as category 11I on the 8823 form. Is that correct, Lisa? Raise your hand, Lisa. She's the one that prints and sends the 8823s to the IRS. So make sure you're friends with her. She likes chocolate candy, expensive jewelry. Well, she'd rather not print the form, period. So yeah. So at recertification, your income limit is 140% of the current credit limit. If the household exceeds the 140% at recertification, the unit is redesignated as over income. It'll show up as OI, and the next available unit rule must be followed. So if they move in and they're over income at their second recertification, do they have to move at a tax credit property? They can stay. But it's going to kick in the next available unit rule, which says you have to rent. When a household is over income at recertification, the unit remains eligible for credits as long as the unit remains restricted, the unit of a comparable or smaller size in the building, which is the building rule, is rented to an eligible household until the building's applicable fraction is restored. If a unit of a comparable or smaller size in the building is rented to an ineligible household, all the over income units in the building lose their low income status and you're not eligible for credits. Make sense? Just like with the student status, if somebody gets a better job that's better than themselves, we don't want to kick them out of affordable housing. You have a hard time in front of a judge telling the judge that they did something like worked hard and got a raise and bettered themselves. Hopefully these individuals will move into the conventional. Sometimes they're not able to because they're in that gap that we'll talk about later with average income. But that's why we have these rules to protect the owner and investor as well as the tenant. So we have 100% tax credit property owners must have policies and procedures in place to ensure that all the units are initially occupied by eligible households. So who's next? So we have a tax credit occupant here. This is occupied by someone that's meeting the requirements. This person in this apartment right here, they're over income. And then this one is fine. They meet their income limits. This person here that moves in this vacant unit, they must be rented to a qualified household in order to stay in compliance. How does it work with multiple set-asides? Units with deeper targeting, 30, 40, 50, will use the project-specific income limits that are published in RCRS and apply the 140% rule to their specific set-aside at recertification. Your NAU and deeper targeting. For a deeper targeting income set aside when the household's income exceeds 140% of the current tax credit limit, the unit is designated. Designation is changed to the next higher set aside, along with an increase in rent to the next level. The next available unit must be rented at the lower set aside to restore compliance again. Is everybody good with that? And of course, there is a question in TV land.
What will happen if the tenant is over income for 2 consecutive years?
Nothing. As long as you meet the next available unit rule and the 140% rule, you're good. They can stay there for 20 years and be over your income limits. It's up to them. They could end up making $1 million and still live at your property because once they're in, according to the tax credit program, they can stay. Other programs have different rules. You'll have to follow those. Did I answer your question, kind of, sort of? Okay. How many of you have millionaires at your properties? How many of you have properties that have car charging stations? Y'all don't in Asheville? I think Asheville does, don't they? Okay, so if you have a car charging station at your property, that means somebody's driving something really nice and expensive in most cases. You should have checked them at move-in. Because if they're driving a Tesla or something, they probably don't qualify unless it's, of course, somebody gave it to them. And it's the boyfriend's, or it's the boyfriend's car and they just drive it. You know how that works. And the boyfriend, of course, the boyfriend doesn't live there either. His car does, but he doesn't. Yeah. All those kind of things you check out. All right, let's go to the next. So let's look at an example. So the income limits is 30% for, it's listed for, and it's listed for the 50%. So a person at move-in, their income was $12,000, so they meet the 30% income limit and rent limit. Then at annual recertification, they got a job. They worked really hard. They went up to $18,500. What is the income set aside at recertification? Right. So you take the 140% of the current set aside, 14, they're still qualified with the 20,049, but they move. The household remains at the 30% set aside until the unit exceeds $20,496. Everybody got that? That 140%, 140 rule. Low income eligible units occupied by full-time resident managers. This is employee units who are also tax credit qualified are treated just like any other eligible household. Agency permission is not required for them to live at the property. The unit is included in the unit mix. You can charge rent, and the households must follow the property rules, including the recertification and student status rules as well. So you have a site manager, it's a small property, they work 10 hours a week. You wouldn't need an employee unit for them because more than likely they would qualify just as your tenants because they're working so few hours. Everybody good with that? But now, if they're not low income eligible, they had a property and they work 40 hours a week and they live on the property. The unit's occupied by full-time resident managers, and it can be maintenance as well. And we call them employee units, who would not otherwise qualify to live at the property are eligible if the employee must be considered reasonably required by the property. It could be you have a hard time hiring somebody, so you need to offer that as a benefit. There could be crime at the property, so you need somebody there at nighttime to be making sure that everybody's behaving. There's eyes on the property, that sort of thing. The unit is no longer classified as a residential unit, so it's pulled out of your unit mix. So you're not 100% low income anymore. The unit is not included in the numerator or denominator of the applicable fraction. Agency approval is required and rent should not be charged. So if you need an employee unit and you do not have one and you need one, who do you ask? No. This is one time I'm innocent. Now, I might have got kicked out of the school, but I'm not the person to ask for this. Well, who does your owner ask? No, well, they could ask Lamar. They could ask Lamar. He's sitting back there. The whole rack row is all staff, except for the lady next to Tanya. You ask Tanya. You email her. And you email her why you need this particular unit. And then we'll keep it on file for you going forward. What happens if my friend here from Texas lives at the property in the employee unit and we have to let her go? Or she relocates to the properties in North Carolina. And so the next person comes and applies at the apartment complex. They don't need that employee unit because they live in this huge house and at the lake with boats and all kinds of things like that, that their parents left them, I guess, or something like that. And we don't need that. Should we email Tanya and ask her to remove that employee unit? No, leave it and still rent it out to an eligible household. It doesn't mean it becomes a market rate unit, but then you can put a regular tenant in it that meets the requirement and collect the rent. Don't give up your employee unit because Tanya goes to lunch today. Her scratch off has the 4 grape clusters. She's not coming back. She's feeling that in her spirit, like she's going to Sitco at lunch. The next person that starts approving these might not be as nice as Tanya is and give that unit back to you. So don't ask for it to be removed. Just hold on to it and use it when you need it. But in that particular case, if you move in a qualified person that meets the income limits and stuff, you can charge rent for that unit. It doesn't become a market rate unit. Everybody good with that? How many of you have employee units at your properties? How many of you want to be living in the employee unit and everybody knocking on your door at night? We're like, that's free rent, but every night they're knocking on your door and they're like, hey, this lady over here, she parked 2 inches to the white line in the parking spot. Can you go knock on her door and tell her to move her car? Yeah, we don't. Yeah. Right, because they don't text you or knock on your door until after hours and you're in the middle of sleep. Like I had a property in Farmville, North Carolina, and the tenant, I don't know how they got my number, but I'm from Farmville, so I guess somebody gave it to them. And they text me to let me know that they were cold because it was an 8-unit apartment complex and they were on one HVAC system. And of course, my response was, you need to get a blanket, right? Put your clothes on or something, because I'm not coming to Farmville. All right. Student rules. Households consisting entirely of full-time students are not eligible unless they meet one of the exceptions, and we covered that in Compliance 101 yesterday. If you weren't here, just look at our student status form. The 5 exceptions are listed there. They need to meet one of those exceptions. So did we have any questions? Is it TV Land got questions? I can't believe it. It's 11:53. Should we go ahead and take lunch? Okay. If you're in TV Land, you come back in an hour. So we will be back at like a few minutes after 1 o'clock. If you're in person today, if you go out here to the right, we're going to be in room number 6, and we're having alpaca for lunch today. TV Land, are we ready to get started? Yeah, it's time to start. Oh, you're fine if you're still eating and drinking, as long as you share with the class. All right, so we're going to talk about income averaging. That is the next topic that we're going to cover. How many of you have income averaging at your properties? Very few. We're going to give you the condensed version. Sound good? Condensed means early, the ability to leave early. Yes, we all like that. But it is an important topic because it has important consequences and it can create a lot of problems. If anyone was asking me about income averaging and selecting it, can't hear me? Okay. Okay, y'all, class has started. That means, do I need to start talking like the teacher? Only I should be talking. If you're talking, then you're going to get an 8823 from Lisa. Okay, can y'all hear now? Can they hear in TV land? Okay, so they're ready. All right. Income averaging. Again, we're going to go over a condensed version, but we do need to talk about just one or two things with it. If someone were going to ask me about our income averaging policy, I would tell them that the best thing to stay in compliance would be to have good tenant software to keep up with that for you. I think we have a clear policy in North Carolina. We were one of the first ones, not the first, but one of the first states that came out with a policy. So we have had to make some changes to it as the policy has went along. But I do feel that we have a good policy, and it's easy to understand what the policy is. That doesn't mean it's easy to do what the policy says. But we'll talk about a few things. If the clicker decides to come back from lunch. Okay. So it's the option that allows you to serve households up to 80%. The reason why we have the income averaging is because there are individuals, once they start making that extra money, like we talked about earlier with the next available unit rule, they're kind of caught in an area where they make too much money to qualify to live as a new applicant, because if they're already in, they're in. But for new applicants to live at affordable housing, but they don't make enough money to purchase their own house or to live at a conventional property because of the increase in the rents. So income averaging is a way that Congress decided and the IRS decided that we would be able to serve that population to make sure that they're able to be housed as well. Properties must maintain an average of 60% AMI or less for the designated units. One of the things, because syndicators and investors are concerned about the average income, is they will build in a buffer space. So they will shoot for 58%, and that gives them a 2% cushion. So you'll see that sometimes with some of the investors. It's available for developments electing income averaging on the 8609. It gives greater flexibility in your unit mix. It supports mixed income communities. It helps reach households slightly above the traditional 60% like we were talking about before. This is normally your fire department employees, your school bus drivers and individuals like that who they make enough where they can live in affordable housing, but they make too much to qualify. So, you know, they don't make enough money to live in conventional world. So this gives them a place to go. The income averaging policy was released in 2022, the Federal Registry. And this is what it looks like if you want to look it up. Our North Carolina policy, we have a few things that are different than what from what the federal policy is. Of course, you know, that has a tendency to happen. And this differs from state to state. So if you're operating in different states, you're going to want to make sure that you're following the policies for the particular states that you're operating in, because there could be some differences. And this is allowed because different states have different housing needs. So what's needed in North Carolina might not be the same thing that's needed in California. So it allows the states to adopt some flexibility. It's only available for new construction. It's not available for rehabs. Applicants electing to use the income averaging have a list of things they must qualify for. And they're listed here, A through D. And then no project can have more than 4 income bands. So you have to pick one of the pick 4 out of the group that's on the 8609. That's a North Carolina rule. Some states will allow you to choose all of them. Good luck with that, keeping up with that. Any project utilizing income averaging will pay a higher monitoring fee per unit. That's because the monitoring that's required by the agency is going to be more stricter. So as we said, even though you have 100% low-income units at a tax credit property, after the first year anniversary full recertification, you can start doing that. Some people call it the short tick, but you only have to do a partial or the update. We require a full recertification. So when we monitor those properties, there's more monitoring for us to do. And we monitor every year at those properties. So that's why there's an increase in the monitoring fee. Income and rent designations are required to float, just like our home units. If you have an issue, you're able to swap status between units within the same building, and then you're able to come back in compliance. Everyone hates that we require units to float, but when they make a mistake and we're able to swap status and switch things around because our units float, they become very appreciative of that policy. All households must be certified on an annual basis. If a household income is increased to the next set aside, the next available unit of comparable or smaller size must be rented to a household of a lower set aside unit until the appropriate mix is restored. And if the household income decreases, it is acceptable to move the unit to a lower set aside if a slot is available, but this is not mandatory. Your resident is going to appreciate it because their rent's going to go down because they're at a lower income limit and lower rent limit as well. Your low income certification review, we look at these on an annual basis every year. Your lower set asides must follow the multifamily tax subsidy program, and any units where the income or rent exceeds the limit of the set aside specified in the low income certification will be reported to the IRS. As part of the annual review, the agency will test compliance. We test this when you do your AOC. We don't test throughout the year. Some investors were worried about that we would just come in randomly and pick a time and start seeing if you're in compliance and then issue non-compliance, but we don't do that. We wait until and review that at the time you submit your AOCs. There are 5 allowable reasons to change the designation of a unit, and they are listed here. What they are part of the federal requirements, so they should be the same throughout each state. Your audit results letter. This is what it would look like if we found non-compliance for your average set aside. This is what it would look like if the designation set aside was incorrect. But we never expect to see minimum set aside violations based on the final guidance, because we will reach out to you before that and let you know that you have an issue. And we will work with you again to make sure that you come back in compliance with the solution, which could be swapping status of units. And again, that's why we require these units to float. So that was the brief version. If you're looking for a more expanded version, because you have a lot of tax income averaging, you can go to our website. You can go to YouTube. You can put in the search bar NCHFA Asset Management. You'll click on the income averaging 9/14/2023 presentation. This is a presentation that Sandy Harris did. She is the Director of Rental Asset Management now. I think that's her title. Is that correct? She's over development, community living, and Director of Rental Programs. That's her new title. This is back in 2023. She, a longer session of it, goes in more detail how to pull the activity report in RCRS to look at that. So that's a good video training if you need a refresher, if you need more information on it. Requirements for our income averaging can be found in our QAP. We monitor at the time for annual owner certification and at file reviews, and we'll work with partners to avoid state and federal non-compliance. Best practices, use a designation tracking spreadsheet or tenant software. Most of your tenant software packages that you use is going to be able to assist you with this. And so you need to pay attention to make sure you enter the information incorrectly in your tenant software so it can track it for you, as well as RCRS. You need to review the averages before move-ins and move-outs and transfers. Train your staff on the tiers and rent limits, and coordinate closely with the compliance and asset management. And so, are there any questions about income averaging? Are there any in TB land? That is very good. And so, income limits and rents, fees, and utility allowances. Did you want this one or the? But you need this. Thank you.
How was lunch? It was good. Okay. So I need to remind everybody, please keep your voices down. Try not to talk during the presentation, and please don't work on your computers because we're being able to hear the clicking of the keyboards. So the tenant selection plans. How many people were going to correct me on the girl's name? Luckily, on Monday, when Amber Burgess shows up to work at a job that she did not apply to and she didn't get hired for, I'll be in Aruba, so I won't have to explain to her that she doesn't work at the agency. It's Amber Payne. I apologize. I don't know why I had the other name on my brain. So income limits and rents, fees, and utility allowances. Stephen? HUD publishes income and rent limits annually for the affordable housing programs. You're going to have your HUD Section 8 limits, your LIHTC elections, the Harris Special, and home. New change will now be published annually following release of federal poverty guidelines by DHHS. All properties that placed in service prior to January of 2009 use the Harris Special Income and Rent limits, if any. All properties that placed in service on or after the effective date of the current income limit chart use the MTSP income limits. They are not eligible for Harris Special Income limits. Properties that placed in service between January of 2009 and the effective date of the current charge will use the highest MTSP chart applicable for income limits. These properties are not eligible for Harris Special Income limits. And the income limits are held harmless, which means they will not decrease after, God bless you, they will not decrease after a project places in service. So the IRS limits are published annually by HUD per county. The multifamily tax subsidy income limits, the Harris Special Income limits, which is placed in service prior to 2009, the national non-metro limits, and limits are property specific and held harmless after the placed in service date. They range from 20% to 80% in 10% increments. Home is published annually by HUD per county. The levels are 30%, 50%, 60%, and 80%. Most people are used to seeing the extremely low, the very low, and the low. And the National Housing Trust Fund, published annually by HUD per county, and the levels are 30%. Section 8, published annually by HUD per county. The levels are extremely low, very low, and low. And the USDA Rural Development, they are also published annually, and you'll see the very low, which is typically the 50%, low, and then the moderate. The 2025 income limits became effective on April 1st of 2025. You'll see them in RCRS. As of now, in April of 2026, the new HUD limits have not been released, so you won't see them just yet. The HUD Section 8 limits are used by properties with project-based Section 8 rental assistance. The income limits may decrease. They are adopted by home program. However, they cannot be used for home purposes until they are released by the CPD and labeled as home income limits. The home rent limits are published separately. The MTSP and HERA special income limits, the multifamily tax subsidy program for use with the tax credit and tax exempt bond programs, and whether to use the MTSP or HERA special income are determined by the placed in service date. The income and rent limits are listed by county or metropolitan area. If property is in a rural area, the property is eligible to calculate the income and rent limits using the national non-metro median income, if higher, and much of North Carolina falls into this category. The tax credit properties that are layered with other affordable housing programs must use the most restrictive income and rent limits to maintain the compliance with all programs. For example, if the property is home and tax credit, the tax credit income limits will likely be higher than the home income limits. So you're going to want to use the home limits to make sure that you stay in compliance. Properties not electing average income on the IRS Form 8609 will use the state mandated deeper targeting income and rent limits. The agency will utilize the highest of the income and rent limits. Therefore, there will only be one income and rent limit applicable to each set aside in a given county. And so when the new income limits come out, go ahead and print them off and keep them in your folder. If something happens that we entered the wrong income limits, then you will not be held responsible if you use the correct one during the time of correction. The rent limits are calculated using multifamily tax credit, MTSP, based on the imputed household size. The gross rent must be below maximum rent limits, which is the gross limit rent is equal to your tenant rent plus your UA plus any mandatory fees that your property has. So remember, in the past, the home rent limits, you also had to include the rental assistance. You no longer have to do that. The rent tied to the income limits, low home and high home. If it's an agency loan, you need to remember to get your rents approved. Gross rent must be below the max rent limit. Change in the gross rent calculation with a new home final rule. Rent limits are determined by the HUD utilizing contract rent. They are based on the tenant payment, the higher of the 30% adjusted monthly income or the 10% monthly gross income. Or they can be determined by USDA using one of the four types: note rate rent, basic rent, the HUD contract rent, the low income housing tax credit rent, based on the gross tenant contribution, the higher of 30% adjusted monthly income or 10% gross annual income. So which limit is used for a two-person household? And if it's a Section 8 or home property layered with low-income housing tax credits, you want to always use the Section 8 home limits. Remember, it's always the most restrictive. To make compliance easier, the agency publishes property-specific income limits in RCRS once they are released. If you follow the income rent limits in RCRS, the property will not have a compliance finding for using the incorrect limits, even if RCRS is wrong. Please print the income and rent limits from RCRS and keep them in your property file. You can go into RCRS to see what your income limits are. There is a drop-down box if you need to see previous years. And to locate your income limits in RCRS, you'll go up to the property list, find your property, go over to property menu, and you just look down at rent and income limits. So rent increase request and requirements are covered in the typical loan requirements section of today's training. The term gross rent includes the cost of any utilities paid by the resident. For tax credit developments, gross rent does not include rental assistance payments made on behalf of the tenant under the Section 8 program or similar programs. Rent limits are determined by bedroom size. The calculations based on the income limits, 1.5 persons per bedroom. Rents are generally set under the applicable rent limits. Rent limits include a utility allowance for tenant-paid utilities. The mandatory fees and services are calculated or are included in the rent. The maximum allowed rent calculation. Again, tenant-paid rent allowances for utilities paid by the tenant, mandatory fees equals the gross rent. And they are available in RCRS and they are property specific. So always go into RCRS and look at the exact property. Rent limit knowledge check. Alistair owns and manages Meridian Park Apartments and wants to increase the rents. The agency approved a rent increase of $600 for his 1 bedrooms and $750 for his 2 bedrooms. Jane notices in RCRS that the rent limit for her community is $800 for a 1 bedroom and $950 for a 2 bedroom. Can she increase the rents to $700 for a 1 bedroom and $850 for a 2 bedroom without agency approval, since the amounts do not exceed the rent limits? Okay. Correct. So even if she stays below the rent limit, if her property is required to ask for agency approval, it has to be approved. So what is the gross rent? You have a 2-bedroom apartment. It's 50% set aside, 3-member household, $800 in tenant rent, and $100 utility allowance. $900. Is the rent limit being met? It's a 2-bedroom apartment, 50% set aside. You've got that $900 gross rent. Yes, because the $900 gross rent is less than the $975 rent limit. So rent increase requests and requirements are covered in the typical loan requirement section of today's training. The term gross rent includes the cost of any utilities paid by the resident. Gross rent does not include the rental assistance payments. Rent limits are determined by bedroom size. Calculations are based on the income limits. 1.5 persons per bedroom, and rents are generally set under the applicable rent limits. Fees in addition to rent they have to be optional and not a condition of the lease. They have to be reasonable. They have to be available to market and low-income households. Reasonable alternative available. Cannot charge fees for facilities included in the eligible basis. Required fees, such as renter's insurance, are allowed. However, the fee must be included with the rent and UA to determine if the gross rent is below the acceptable limits. Owners must provide an option to pay rent in a manner that does not involve additional out-of-pocket costs to the household. Some of those options could be providing a drop box at the office. They may be able to mail the rent to the home office, etc. But you have to provide a free option that makes the processing fee voluntary. So I think a lot of companies now are going to this online payment and they have to pay a fee in order to use it. If that is the only way that they can pay their rent, you have to change and make it so that there is a free way to do it as well. So that if they want to do it and pay the extra fee, that they can, but they don't have to. Failure to disclose the mandatory fees on the tenant income cert or exceeding the rent limit will result in findings of noncompliance. And we will know. All of your residents have our telephone number. They will call me. So allowable fees are non-mandatory fees for meals, late fees because they don't have to pay their rent late, pet fees, they don't have to have a pet, a cleaning fee for use of the community facility, and application fees that do not exceed the average out-of-pocket costs. but non-allowable fees would be covered parking where the cost was included in the eligible basis and there is no other place to park. Redecorating fees, transfer fees, washer dryer hookup fees, separate fees charged to the tenant, facilities such as pool, laundry room, garage, storage, when the cost of those facilities were included in the eligible basis. If the fees are charged, they should be listed on page 2 of the tenant income cert. So again, what is the gross rent? You have a 1-bedroom apartment. It's a 40% set aside, 2-member household. They have a $750 tenant rent. They have the required $50 monthly renter's insurance, and they have a $100 utility allowance. $900. And is the rent limit being met with the added fee? Correct, because it's not being met because, well, it exceeds it because the 1-bedroom unit cannot exceed $794. Utility allowance requirements. All projects that participate in agency-administered rental programs must update their utility allowance at least once annually through RCRS. Implementation can only occur after the agency's review and approval. New properties, you do not have to submit a new utility allowance until after the property has reached a 90% occupancy rate for 6 months or after the first year of placed in service. With each request, all utility allowance types must be uploaded into RCRS with a cover letter indicating the utility type and effective date. Costs are incurred solely by the owner. The utility allowance includes all utilities paid directly by the resident. Owners management are allowed to utilize the multiple methodologies when calculating the UA, except for RD and HUD properties. They are allowed to switch methods year to year. Requests can be submitted anytime during the year. The required processing fee, if applicable, should be paid prior to submitting the UA for review and approval. Processed, approved within 30 days of the receipt of information submitted correctly. So again, once you resubmit, your time starts ticking again. Owners cannot bill tenants for utilities based on unit size, number of household members, or other general allocations where conservation efforts by the household do not reduce the bill. The owner can separately bill the tenant for utilities if the units are sub-metered. We can only make a difference in the type of unit, garden versus townhouse. There is not an option for a difference in square footage. When using the PHA UA for the entire property, please make sure you are using the correct one. It must be effective within 90 days of the PHA making it effective. Know if your site pays for water and sewer. If the tenants are paying for water or sewer and the utility studies are not reflecting that, you have to tell the companies that are performing these studies. Rent increases will not be approved without a current UA. Failure to maintain an acceptable, up-to-date UA may result in the management ownership to not be in good standing with the agency and non-compliance for the project. We find this during a file audit. For approval dates with RCRS, we use the date of the study and or the effective date of the PHA. The PHA utility allowance will also be entered the same way, and you have 90 days to make it effective at your property. If you receive vouchers from different agencies, please indicate the one you use the most, as our system only allows for one. And you're going to mail the fee to the agency prior to uploading into RCRS at least 2 weeks prior, because you know the mail system is running slow these days. So there's 6 options of calculating utility allowances. We took one off and I forgot to change the number. So you have RD, rural housing, must be used if the building or residence received assistance from RHS. HUD must be used if the building is HUD regulated. The utility company estimate, agency estimate, the HUD utility schedule model, or the energy consumption model. And you can find additional information on our website. Make sure you check for updates. And if you have any trouble or if you have any questions, you can reach out to Tammy Douglas. Does anybody have any questions?
So we're going to talk about acquisition and rehabs. How many of you have or getting ready to go through one of those? Are you excited? You're not? Why? But your property, oh, well, you're not going to make the money from it either, probably. Yeah, I understand that. All righty, so let's talk about that for a minute. Your organization purchased a 40-unit apartment community using affordable housing funding. The property is occupied and the rehab work is scheduled to begin. Some units will need plumbing repairs, new HVAC systems, accessibility upgrades. Residents are concerned about notices and temporary moves and rent increases. So what are you going to tell them? Or how are you going to handle it? Well, that's going to help that you're paying for everything. Is the rent going to go up? Sometimes. The important thing is you're going to want to make sure that you communicate frequently and often and in advance with your residents. Let them know what's going on. You also know which residents have challenges and they get excited about people coming to the apartments inside of them. The targeting program tenants, for example. So it's very important that you have open communication and let them know what's expected of them and what they can expect from you as the management company and as well as from the contractors. So an acquisition and rehab is buying an existing affordable or market rate property, making improvements to extend its useful life, and keeping housing affordable for current and future residents. We have adaptive reuse. How many of you work for a management company or you manage a property that is adaptive reuse that would meet that definition? I think my friends from Northwest, y'all do. Y'all had the hospitals, schools, stuff like that. That's when you have a significant landmark in your community and you don't want to see it torn down. So they convert it to affordable housing. And so there's right much of that. Kinston has a lot of that with the theater, the hospital. There used to be one in Kittrell, North Carolina. There was a college there, and they took the teachers' housing. They had little individual houses in a little circle row, and they used adaptive reuse funds to preserve those houses that the teachers lived at years ago. When an existing tax credit property receives a new allocation of credits, this is called a resyndication. The building identification number stays the same and the new allocation is layered over the original. The property is subject to both sets of requirements until the compliance period for the original allocation expires. So you're in, at your property, you are in year 22. You come in and get credits. So then you have a 2027 allocation. So you have to follow that from, what year did I say before? Yeah, 2022 and the one from 2027. Well, that's not going to be that close together, but you know, you get the idea that you got to follow both of them until the first one expires. So you could be following the QAP for two different QAPs for one particular property until that first one expires. Everybody good with that? If the property is located in an area where income limits have decreased in the past, the property will be required to reduce the income and rent limits on the new allocation, causing a reduction in rents and a change to the screening criteria. The new allocation will be layered on the existing property in RCRS once the application is at the correct step in development. So why do we do acquisition and rehabs? It preserves existing affordable housing. So if you're in year 29 and you enter in year 30 and you're done with your compliance period and your extended use period and your LURA will let you out, says you're done, what can you do with your property? You can go market rate and charge higher rents. But if you get a new allocation of credits, you're locked in for another 30 years. So in doing so, we have preserved affordable housing that's stocked there for another 30 years into the program. Does that make sense? So that's one of the goals of acquisition and rehab. And then it's often faster and less expensive than building something unless the property's in really, really bad shape. And then it minimizes displacement when it's done correctly. So some of you will be involved in some acquisition rehabs where the tenants will stay in place and the contractors will work around your existing tenants. And then there'll be some that you'll move to different units as the work goes on. And then there's some that you'll move completely off property. It just depends on the amount of work that has to be done. And it's really up to the owner and the developer how they want to address that with the work that's done. Common funding sources to do this is low-income tax credits. That's our tax credits that we offer you, the Housing Trust Fund, and then state and local grants and loans. So we have state money that's available to you, like the WELT program, the Housing Trust Fund, the home program that we administer. And then sometimes your cities in different areas have money through the home program, or either they have allocated money through their budget, the city or county budget, to add to the money you get from us. So you have layered funding, like we talked about yesterday, to make these deals happen. The only thing you have to remember is all of these have different requirements that you're going to have to follow. Federal tax incentive for affordable housing. The credits are claimed again over 10 years. Property must meet the income and rent limits. For the acquisition basis, your property must be at least 10 years old, must be an arm's length purchase. So you can purchase. So sometimes the owner will sell the property to themselves, kind of, sort of, to another family member. There are certain requirements that have to be met with that. And that's why we call that with the arm's length purchase. Some costs are eligible, others are not. If you have a rehab, improvements must meet the minimum spending requirements found in the QAP. And then repairs can include roofs, HVAC, plumbing, and accessibility upgrades. Is every building at the property going to get a new roof? Depends on how good a shape that roof is. We're not going to tear off a roof that you replaced 2 years ago just to complete a rehab. We're not going to replace an HVAC unit that you replaced last year with a new one just because we've got rehab money. Same thing with appliances and anything else that they fix during the rehabs. We're not going to throw away something good, but we will have to look at those. And normally, I think Don and Toby come out and do those now. Did I say Russ? Oh, I said Don, didn't I? Okay. Make sure I got that right. Again, an important reminder is communication between the business owners. The owner of the property needs to communicate with the investors and the site staff and with the residents, what the expectations. So everybody needs to be on the same page. During this rehab process, you'll hear from the state, but probably who you will hear the most from is from your syndicator or your investor, because they are really concerned about those credits and how quickly they're able to claim those credits, because they want those credits as quickly as possible. Acquisition and rehabs impact on existing residents. Existing residents are not grandfathered in. New certifications are required, may have other programs, but do not have existing tax credits. And then Resyndication with existing LARA must comply with both LARAs, as we mentioned before. This is for existing eligible households remain qualified after resyndication. New income certifications need to be performed on existing household. State noncompliance for failure to certify households within 120 days of the acquisition. And again, your investors are going to be really on that to make sure that you get those done as quickly as possible. Resyndication without an existing LARA, your existing residents are not grandfathered in since the previous term has expired. New certifications are required, may have other programs, but the tax credit extended use period is expired. Susan wants to remind everyone, because she gets asked this question often and frequently. And if you know Susan, she loves the beach. So she's all about the parrot thing because she likes the beach or she likes water. If a property gets a new allocation of credits after the current LARA has expired, the residents are not grandfathered. Make sure you pay close attention to this potential issue. So we had a property and we're past the 30-year period. We're in year 34. The LARA is not going to apply anymore. The QAP is not going to apply anymore. So everyone is not grandfathered because all that's expired. So just keep that in mind. If you have any questions, you can email Susan. Acquisition and rehab, your activities in RCRS, this is very important. For properties that were not previously tax credit, all existing tenants must be entered as new move-ins using the acquisition date as the move-in date. That's in RCRS. Any tenant move in after the acquisition date, the move-in effective date is the actual date of the move-in. If transfers is, you have to transfer some tenants around from unit to unit as you do the work, and it's not permanently, but it's temporary, then a transfer or move out is not required, but you would continue your annual certification process. Everybody good with that? Resyndication, you enter in the initial cert for the existing tenants using the acquisition date as the new effective date. You no longer have to show them as a new move-in under the new allocation as previously requested. Showing it as a recert causes the agency to pull the wrong unit event for the file review. We review the qualifying unit event for the new allocation, not the original move-in before the allocation. The agency only goes back, and I don't know why we got gooses flying around, but the agency only goes back to the original move-in if the household is over income and wouldn't qualify under the new allocation. Minimum rehab requirements, you must spend a minimum amount per unit. Ensures meaningful improvements are made. The amount varies by program and year. Existing tenants may remain if possible. Temporary location may be required. And again, communication is the theme of rehabs and resyndications and acquisitions. Income and rent rules. Households must meet the income limits. Rents are restricted based on the income limit. Income levels. Limits are updated annually. You can find them in RCRS. The compliance period is just like the previous ones we discussed earlier. The first 15 years, the initial compliance period. The extended use period is 30 plus years. Non-compliance can result in penalties. Missing paperwork is common mistakes. Missing paperwork, incorrect income calculations, including ineligible calls, poor communication with residents. The best practice is to start compliance early, keep organized records, coordinate development and management teams and terms, ask questions before issues arise. Acquisition and rehab preserves affordable housing, as we mentioned before. Rules must be followed carefully, and good planning prevents compliance problems. 5 reminders: what concerns residents might have during the rehab, why is the communication important during the process, what could go wrong if residents are not informed properly, who should staff contact if they are unsure how to handle a resident concern, and how does this scenario show the purpose of compliance rules. So concerns that the residents might have is what's going to happen to their stuff. Where's their bedroom suite going to go at when they're coming in to replace the carpet? What you going to set up? Are you going to move everything and leave it on the patio overnight? Or are you going to put it in a pack rat? Or are they going to put it in storage? And then, of course, who's going to pay for all that? Why is the communication? Because it lets them know what they need to do, not only as far as inside the unit, the work that's being done, but when they need to come to the office and bring that paperwork. So it's very important that you let them know what paperwork they need and when it needs to come to the office. What could go wrong if the residents aren't informed? So you have a contractor comes and they're installing new cabinets in the kitchen, and you sent them a notice saying they need to take everything out of the kitchen cabinets because they're going to be replaced. And Ms. Johnson's supposed to do that on Monday because they're coming on Tuesday. They come on Tuesday, all her china is still in those cabinets. What could go wrong? It could be really bad. Because first, they're not going to be able to put the cabinets in. And if they do put them in, the contractors are going to move her china and they're going to break it all. And it's going to be like Queen Elizabeth's china that came over on the Mayflower or something. You could always count on that. So yeah, it could just go downhill really, really fast. And we laugh, but it happens. How many of you had that happen before? Yep, see, I didn't make that up. I've been through this before. Who should staff contact if they're unsure how to handle a resident concern? If you're at the site level, contact the home office. If you're the home office staff, you're going to contact the owners. And then you're going to stay in contact on a regular basis with your contractors that are working at the property because they're going to let you know the timeline schedule. You know, if they're still on schedule to come out at particular times. So how does this? So focus is on awareness. Remember to care for people, and everyone has a role. Acquisition rehab is not just about building, it's about preserving homes and protecting residents. And are there any questions? Who wants to have a rehab? Who volunteers? Nobody? All right, who's next? We're going to take a 10-minute break, so come back in 10 minutes because some people's alpaca might need to escape. Those little llamas going to be running around the property. All I know is I'm done for today. I'm going home.
Only 5 of y'all. There we go. There we go. There we go. There we go. Don't you worry. After 2 days, we are also done. Let me fix this. All right. And now if we can all, there you go. Man, y'all are good. All right. We got one last section, but I still want y'all to ask questions if you have them. Because if we leave too early, we're going to have to add material because we didn't make the class long enough. So there's people in virtual land that know what time we end. But there are people who may or may not pay our paychecks that are in virtual land that know when we end. So ask questions, don't be afraid, but this is our last section. And we're going to do tips for compliance. I apologize if you were here yesterday. Some of it may be duplicate, but there are a lot of people who were not here yesterday. And we in the compliance world want to make sure that you know how to have the best possible reviews so that you stay on the approved management company list. So when we come out and do your inspections and do your file audits, we send you those lovely letters that say no findings. Makes our job a whole lot easier as well. We don't like to write up the 24 pages of findings on a physical inspection. Stephen might enjoy it. I don't want to do the letters, and we certainly don't want to do the responses to those because they take days. So our monitoring frequency, with the caveat that this may change in the future. We are reviewing all of the things. But if you are pre-monitoring, that's a new allocation, and you have no other all programs that are in the pre-monitoring world, we have to do 20% of your units that first that first year while it's in pre-monitoring. We will do your file review after the first 6 months of placed in service. We are trying not to get your files right there in the heat of the lease up. So we're going to wait at least 6 months until that first big push, and you might be just on the last couple of units if you're not 100% occupied by now. So we're really trying not to do the physical inspection or the files during lease up. We will do the physical inspection when you are like 90% or better leased up. If you have tax credit with no agency loans and you have less than 100 units, we're going to come every 3 years. That's for files and physicals. We will do a minimum of 5 units. So even if you're a 20-unit property, we're doing 5 units. In the extended use period, if you are tax credit with no loan, we're only going to do 10% instead of the 20. If you have more than 100 units or you are average income and you are tax credit only, we are coming every year, even though we could come every 3 years, because we have some properties that are almost 300 units. We are not trying to do 60 units every 3 years. So we're going to come out every year, do a smaller sample size so that we are not there for a week and that you aren't dealing with us for that long on those inspections. Nobody wants to do that many units at one time. So we're going to do a smaller sample size, but more often. If you have an agency loan, the state tax credits, we're going to come out every year and we're going to do 10%. Okay. But we are coming. If the affordability is over and the loan hasn't been paid off, we will do a physical only and we won't review your files. So you might see like physical only as the compliance type and we'll do 10% of them, but we do it every year. If you are out of the compliance period and paid off the loan, but you still have targeting units and you still have targeting households, key households, we will still do physical only, but we're only going to inspect those DHHS units. If we're still giving you money, we're still going to make sure that you're doing what you're supposed to do at the properties. Oh, if you are a shelter, you got supportive housing, you got shelters, the transitional housing where you are heavily monitored by another agency, then we will do what's called a curbside. We're literally just going to drive by and make sure the building's still standing. There are enough other people that are there that are doing your licensing and all of that. We are just driving by just to make sure the building is still there. Scheduling an RCRS in January of every year. Our compliance monitors put in their rough schedule for the entire year. So generally speaking, in January, you can go out and you can kind of get an idea of when we're going to do the physical, when we're going to do the file. If that changes for any reason, emergencies come up, then the compliance monitors are supposed to go in and adjust that. So if they were thinking they were coming in June, things happen, they're not coming in June, they're going to come in August, they should go up. They should go and update that as well. So check often for revisions. For physical inspections, our staff will email whoever's tagged 30 to 60 days in advance to actually schedule the inspection. You won't get the letter in RCRS until 14 days prior, but you'll get the email confirmation that it's scheduled. If you see in RCRS, if you see a month and a year, that is the rough schedule. It's not been scheduled yet. If you see for the actual date and a time, that means somebody has confirmed that inspection. So somebody with your management company has confirmed with the compliance monitor that it is okay to inspect, and that is the date and time of the inspection. So again, if you see just a month and a year, nobody has emailed you. You may have confirmed and they're not updated yet, but it has not been confirmed in the system. If you see a time and a date, somebody has said, yes, that's okay, and it's been confirmed in the system. The files, it shows the month and the years until the files are requested. So that that month and year will be there until they have sent you the notification letter and you've got the 14 days to submit them. Also in RCRS, you're going to see the compliance person's name, phone number, and email address. The notification letters, again, in RCRS, the physical inspection, we're going to email you 30 to 60 days in advance to schedule that. The notification letter will be released 15 days prior, along with the tips for a successful inspection and our state non-compliance policy. File reviews, that notification letter is released 14 days prior to the due date of the files. It lists everything that you are required to send with the files. And please use that 14 days to do what? Self-audit your files. Please do not get the notification letter and say, oh, it's good. Click. Self-audit your files. Yes, ma'am, Miss Lisa, what you got to tell the class? So the question is one of our compliance monitors realizes that files are due and she reaches out kindly to management saying, hey, you have files due and you haven't hit submit. And management says, oh, I didn't know. Any guesses as to why they didn't know? Because the wrong person is tagged and the wrong person got the email. So two things happen when you get a notification letter. One, you get an email from RCRS that says, hey, you got a notification letter. And I believe it attaches the notification letter. It doesn't? You have to go find it? Okay. It's been a minute since I've been on that side. So you get an email to who? Who gets the email? The only person who gets the email is the person who is tagged. For file reviews, it's got to be the file review person. For physical inspections, it's whoever's tagged as a physical under physical inspections. Does anybody else get that email? The owner, whoever's tagged as the AO, I think also gets the email, or the operations contact also gets both of them. The file inspector and the physical inspection. Those are the two most important things. They're the people who are going to get the email. The second thing that happens, everybody knows the little red dot up in the corner. Everybody who has access to RCRS gets a little red dot if the property in your login gets a notification letter. It's not going to warn you that you got a notification letter. So it's up to you to go check the little red dots to find out what they are. So if you log into RCRS and you see the little red dot, you need to go see what's out there. Okay. Yes, Stephen, in TV land.
Are residents required to sign ticks during the self-certification?
We've already answered that question.
Okay. Unit designation change, household is over income in the building once at 30%, and another household on the property, not the same building, is at 60%. Same bedroom size and square footage, but meets the 30%.
Are they asking if they can swap the status?
Can I swap the designations? Is there any instance would the property have to wait for the vacancy to swap or wait for a unit in the same building to qualify for the 30% that would be available?
That's a lot of words. And if
It was a lot to read.
if I'm understanding correctly, you do not have to wait for.
And you
vacant
remember I got
unit.
kicked out of the 6th grade, so I didn't graduate past that.
Correct. You do not have, in generally speaking, in order to swap status, you do not have to wait for a vacant unit. But there are other things that come into play, like, are you average income? Do you have to make sure that your bedrooms meet the average income? And that kind of thing. But you do not have to wait for a vacant unit if you've got 2 units that could swap, that are the exact same type of unit and all of the things. There's there's a lot of things that come into play with the type of funding, where you are in your IRS period and things like that. It doesn't trigger 8609 because people didn't move out and transfer and that kind of thing. But you don't want to have all of your 30% individuals in one building and all of your 60% individuals in another building. So if you only have 30% units, you don't want one entire part of a property to be your lowest income qualified people, but you do not have to wait for a vacant unit to swap status. Mhm. I don't know why you did that.
Well, then you have a next time open that was at 30%, but it's not this person's recertification date, or it's still staying. Can you do an insurance to give that person that 30%?
So the question is for TV land, so they know what we're talking about. We have an individual who qualified at a 30%, but for some reason, management moved them in at a 60%, and it's not working out so well. But we have a 30% unit available, and she is asking if we can do an interim certification to move them to a 30%. Now, there's a couple things that you need to remember. There's no such thing as an interim certification in the tax credit world, okay? Second of all, what does your tenant selection plan say you are going to do with lower set-asides and current in-place tenants? That is your answer. What does your tenant selection plan say you do? So a lot of the tenant selection plans, I've not read every single one of them, but you have to ask to be put on a lower set-aside waiting list. And so then it has nothing to do with recertifications. If you know that they income qualify and they're on a waiting list for a lower set-aside unit, and you have one that comes available and they're the next name on the list.
So what would you do though?
You're just doing a swap and unit status. But you're not doing an interim certification. You're following what your tenant selection plan tells that you're going to do for your lower set-asides for your current in-place tenants. We got another TV land question.
I have two more right now. Do you still conduct physical inspections during the rehab process?
Yes.
Thank you. And then the next question is, can a spouse be listed as the other household member, or do they have to be listed as the co-tenant?
There are 0 rules when it comes to what you list adult household members as on the TIC. I mean, they can't be a child, but that's not your choice as to whether they want to be listed as a spouse or a co-head, or because the lease just says that only whoever's listed as on the lease. The TIC and the lease are different. Everybody has to sign the TIC, but nobody's going to tell you what they have to be listed as. Does that answer that question? All right, are we good? Did any of those come up with more questions that we need to talk about? We're good? All right, so what's important? Back to this here, notification letters. Tag the correct people so the correct people get the notification letters so that you're actually submitting the documentation on time. Because what happens on day 15 when you didn't hit submit that the files were due? You're now getting an email saying you didn't respond and you're in non-compliance, and nobody wants that. A simple fix, make sure that the right person is tagged in the system. And check your red dots. When all else fails, check your red dots, okay? Obviously, the more properties you have access to, the bigger your number is on that red dot. All right, so our top 10 file review findings. Yes, TV land. Hey, start over.
Can a man and a woman, well, that's a problem right there. You start,
Not what it is.
y'all said it, I didn't,
I do not.
who
want-
are engaged.
Oh, okay, they're getting married.
So they
Got
got two problems.
it. Got it.
Can they apply for a 2-bedroom unit? Yes. Yes.
I don't even want to answer that question out loud. Okay. If it's a tax credit property, there are no rules as to the
If they
number
can
of
afford it.
people and the number of bedrooms they are allowed to have. They can apply for an efficiency apartment, a 1-bedroom apartment, a 2-bedroom apartment, a 3-bedroom apartment, a 4-bedroom apartment. Anybody got a 5-bedroom? All right.
If they can afford it, they can have it.
They can afford it, they can have it.
And the next question. Is there a reason why some properties are not listed under the file review schedule?
There are a couple of reasons they could not be listed. So if you are not seeing your property under a rough schedule and something is scheduled for this year, you might be on a 3-year rotation to where this is your off year. There are a handful of times when maybe the rough schedule isn't 100% entered into the system. And so your property hasn't shown up yet. But the biggest reason is we might not be, it might be an off year this year. If you have questions and you're not seeing your property listed and you think that it should be inspected or reviewed because you know what type of funding and you know what it's supposed to be, don't be afraid to ask and reach out. We would rather say, hey, we gave you the year off. This year we did. We've got some properties that we're supposed to go to every year, or maybe this was year 3 for your property. But our schedules, our compliance monitor schedules are so heavy this year that we had to skip a year for some that are like in the extended use period or on the approved management company list where we know that management's good, that kind of thing. So there are weird times when you're not on the actual schedule, but for the most part, it's because you're on an off year. But if you have questions and you think you're supposed to be monitored, just reach out and we can make sure that we didn't miss something.
Yes, you can reach out to Randa. I have an
I'm just gonna
upcoming
forward it to Steven, it's
inspection,
fine.
but do not see any red dots, or most do on RCRS. We have confirmed the inspection via the email.
Okay, say that again.
I have an upcoming
We have an upcoming
inspection,
inspection. Got it.
but do not see any red dots.
Okay. If
Must,
it's more than 15 days away, the notification letter has not been sent and you won't see the red dot. And the physical inspection, just the notification letter for a physical inspection, the red dot isn't going to remain there because you don't have to do anything. So the red dot is to inform you that you have to do something. So the physical inspection, you're not going to get a red dot. You're just going to get an email and you're going to get the date and time show up in RCRS. The red dot is to only let you know that there's something that's living on your side of the system that you have to act on. Yes. Thank you for those words, Lisa. Action required.
she's referencing an inspection that's going to take place at the end of this month.
Okay. So again, the red dot isn't going to stay there because there's no action for her to take on her part in the system. Her
Well,
action
after the inspection.
until after the inspection and she gets that compliance results letter, and then the red dot will be there for her to respond to that compliance results letter. Make sense? Got it. All right. File reviews, top 10. These are things I sent an email to our compliance staff saying, hey, give me your list of your top findings, right? And so we understand that mistakes happen, but when you get the same mistakes over and over and over and over and over again, we need to work on that a little bit, okay? So our number 1 finding across the board were applications not being completed correctly and completely. Believe it or not, leaving blanks doesn't mean that it's not a thing. It just means they didn't answer the question. One of the top findings is when you have multiple household members on the application, you have to answer the income and asset questions for all of the household members. That includes what? Children. Can children have bank accounts? Can children make money? Yes. Do a lot of parents get SSI for their children? Whose money is that? Children's, right? It says the child's name on it. So on the application, when it says head of household, income and assets, great, everybody's got that, right? But when you have dependents, one of our number one things is you guys not filling out the application for income and assets for the children. So make sure you're filling out all the questions on the application and not skipping boxes. There isn't a line that goes all the way down. They need to answer all of the questions. Okay. Not completing or providing the supplemental information form. Okay. They either have to initial that they're not going to supply the information or they're going to have to supply the information. It's that simple. If you have a secondary form that you are using, or if your application asks the questions, you don't need the form as long as your application asks all of the questions. Every form I have seen out there that isn't ours misses veteran because that's a state rule. That has to do with North Carolina, not even NCHFA, but that is a state of North Carolina requirement that we ask those questions, not an NCHFA rule, and disability. So a lot of the HUD forms or the demographic forms, they all ask race and ethnicity. Most of them, some of them ask gender, but they don't ask veteran status and they don't ask about disability. And so those are things that we have to collect. So again, if you have an application that has those forms, all of the questions, you don't have to fill out this form, but you have to have something that asks all of the required information. Okay. Yes.
So just say you have that gets such a child, just a child, she don't get it, just a child. That's all you can be teaching for child, say for child. I always would put in Social Security, and I would put, just say 10 for Johnny. That's why I believe. So when I put that income on the should just be, and when I put it under John, that's right.
So the question is, this household gets income SSI on behalf of the child. And that is the only income in the household. We are not going to put you in non-compliance if you put SSI under the adult, but answered no under the child on the application. Okay. But you still need to answer all of the income and asset questions for both the adult and the child in the household. Technically, that's the child's money. But as long as you've got Social Security listed and you have answered all of the income and asset questions for both the adult and the child, you're going to be fine. Our issue is when you didn't answer the dependents questions or the other applicants questions when there is just an adult and children. You guys are good if there's two adults. Where everybody misses it is when there's one adult and dependents. You're not answering the income and asset questions for the dependents. Yes. Yes. Yes, ma'am. Mm-hmm. Hang on one second. I can't hear her question. Thank you.
So if it was just an example like David Jones or, Susan whoever, that would be the dependent child or say the adult, but they're at home in the house.
Yep.
So it's the money for the child, but it's the actual mom does not have income.
Yep.
So when you do the actually put Baby Jones and zero income, but the income's gonna go toward that adult child.
Correct. So she's asking like who, if you, again, that same situation where you have the adult receiving the money on behalf of the child. Technically, it is the child's money and it's going to be listed under the child. However, if it's listed and that's the only income, we're not going to write, it's not non-compliance for putting it under the wrong individual because it's a weird situation. We just need to make sure that you are asking whether the dependents of the household get assets and income. Okay, you need to ask the questions. Yes, ma'am. That's fine. You can put it under the child. There is income coming into the household to help pay the bills. So if the adult, if that adult has zero income, then they would have to fill out a zero income statement. But again, you guys are thinking about SSI on the behalf of the child way too literally at this point, okay? Because everybody knows that is money for the adult who cannot work to take care of the child who is disabled, generally speaking. So that is money to help pay the bills for the house, but it is the child's money. And a lot of those SSIs, you could get audited of how you spent that money because it is technically the child's money.
So if a 15-year-old teenager has a part-time job at fast food place, do we count that as income?
So the question is, a 15-year-old has a job at McDonald's. Do you count the income? The answer is no, you don't count the income. Did you ask the question?
I get that, but we wouldn't count their assets.
Correct. But you're not counting their income. Yes. But the question, the bigger part of the number one finding is you're not even asking the questions. Okay. As you're not noting what income and assets the dependents have. Okay. All right. RCRS not being updated within 30 days of the unit event. This is one of the top findings still. Y'all, this is almost 10 years that we have been requiring this. When did it go? 2016, wasn't it? 2016 is when the requirement started. 2018, I think, is when we started making it non-compliance. Y'all, it is 2026. I get the ones or twos. You had a staffing issue, but we're not talking about ones or twos. Some of y'all are getting it wrong all the time. 30 days. 30 days to update the unit event, 30 days for move-in documents. 30 days. It hasn't changed. 10 years. 30 days. Management documents being outdated. If you just took over new management of a property, I don't want to see the tenant selection plan for the old property or for the old management company. I don't want to see the affirmative fair housing for the old management company. You take over a new property, get to writing. Okay, you got to update it with the new stuff. I'm done with TV land for a second. I'm getting, yes.
We took over 47 properties recently. Does that mean I have to do 47
does.
tenant selection plans
Yes, it
and
does.
47 affirmative fair housing marketing
Yes, it does.
plans? And how long do I have to get those?
I know you took 32, but that's why I said, is this your people on the computer?
How long do I have to get them done?
There is nothing in writing that tells you how long you have to get it done. However, if we request files and it is wrong, you are getting a non-compliance. Okay, so you're going to start with those that are what? You've got a rough schedule of when we're going to do the files. Start with the ones that we're getting ready to do first. So you start with the ones that we're getting ready to do first, and then you work your way down. But yes, the answer is yes. You have to have 47 new affirmative fair housing marketing plans and 47 new tenant selection plans. Shh. You got to do 47. Got it? Who are you going to start with? The ones we're coming to first, right? So how long is an affirmative fair housing marketing plan good for? 5 years. Correct. The date of the signature. Not the date approved in RCRS. The date of the signature. I can't help it. Y'all took 2 years to upload it. Okay. The date of the signature. So update those. RCRS not matching the provided documentation. It's an easy one. And if you made corrections to the file, correct RCRS. But if it doesn't match, guess what's wrong? Your AOC is also wrong. So remember earlier when we said print out those property activity reports once a month and check all of the stuff. So if you get in the habit of printing your property activity report the first week of the month and you are only checking the previous month's information, you know what ticks you had signed the month before, right? You know what recertifications you did. You know what move-ins you did. You know what move-outs you did. It's a whole lot easier to check 5 documents versus waiting and checking all of them, right? So if you are in the habit of printing that report on a monthly basis and only checking what you changed, chances are it's a whole lot easier to update your AOCs at the end of the year. And it's a whole lot easier to even audit your files and making sure that RCRS is correct because you're doing it on a regular basis. Yes, Tanya.
Just to be rich, a lot of back then, but they have not used and now they're trying to struggle all errors are made in your and we have more problems where they're finding out that documentation data entry was wrong. And so we're having to send the AOC.
You should be.
Because this some step just wasn't. It would take the time every month. It's easier to put something in the year term than it is to try to fix it the next year. Because these months, when that AOC goes in, everything concerning the property that prior year.
So what Tanya is reminding everybody is the importance of running that report, specifically for the AOC, and not waiting until the end of the year to make sure everything is to right and to make sure that you are entering everything, because of how difficult it is. And sometimes these units have had 3 or 4 unit events, right? You've had to move in and move out. You've had to recert. Well, you can't start in December with December stuff because you got to start all the way back in January with January stuff. But the minute you submit the AOC, or the minute you open it, I don't remember if it's the minute you open it or the minute you submit it. Either way, you're working on your AOC. So it's the first of the year. It's before February 10th. And you're starting to work on the AOC for the previous years. Everything is locked at that point. You cannot edit anything without us rejecting the AOC in order to reopen everything. So print those reports on a regular basis and self-audit. It's super easy. And even if you don't have, even if there is site level people in here that don't have access to RCRS, ask your regional to send it to you. It's super easy for you to also look and see if the information is right. You don't need the system. You just need the report. You can then tell your compliance or your regional, hey, these are wrong. Take ownership in your property, ask for the reports and look at it. Even if you don't have access to RCRS, you can still ask for the report. Okay. So recertification documents not being uploaded. This is a big one. This is a big one because it's not required for you to upload the recert for every unit, only those that are requested during a file review. So sometimes you forget. There are 2 ways to do it. There is a preferred way to do it, but there are 2 ways to do it. The way that our compliance staff prefers you to do it is to upload the recert in the file review. So you've got the file review and you're uploading the documents. That way we don't have to leave the file review and go back to the buildings and go to the unit number and look for the recert. When we open that document, open that event, all of the recertification document is right there. And we don't have to go search and hunt for it. If you upload all of the documents under the building, the unit number, the most recent recert, you guys tracking with where I'm at here? So if you go under the building to the most recent recert and upload them under the building, it's fine. It just takes us, our compliance staff, longer to close out a screen and go back to another screen to go hunt and find it. Either way, you have to submit the most recent recert if there has been one. Got it? Yes, ma'am. Not under the move-in documents, under the buildings. When you're in the file review, it allows you to add documents in the file review. So when you go, you can't add research to a move-in. But when you're in the file review and you're at the property and you say, yep, I want to confirm all the documents and confirm everything that's in the file review, you can add documents there, and you're going to add the research documents into the file review. Yeah, not going to the building out of the file review section. Everybody good? Again, they're both the right way. There's just a better way. And our compliance staff, it takes a long time, does it not, to leave the file review, go back to the buildings, hunt and peck and find it and all the things. So failure to upload all of the documents. We get missing forms all the time. Where are you going to catch this? In that 14-day self-audit, right? Duplicate asset verification. Stephen talked about this until he was blue in the face yesterday. You need 1 or, not 2. Okay? Asset verifications are the biggest to be duplicated. I don't need the asset self-cert and third-party verification. Pick one. Okay? Home properties, not providing the 2-month source documentation. Hopefully this will go away far more since you can now mimic the tax credit. Okay? And uploading unnecessary documentation. We do not care about your VAWA addendum or your drug-free housing or your bed bug policy or any of that that is on a property level. Please only send us what we asked for. Because if you send it, we got to look at it. We don't want to look at it. We don't want to find anything. Okay. Updating our CRS, again, review the stuff monthly, ensure the move-in documents have been uploaded within 30 days, ensure the management contacts are tagged correctly, check that lovely, whoever this login that I pulled from has got a lot of properties. I don't remember who I mimicked when I did this, but they got a lot. Okay. Check your work. I know that I mimicked somebody high up in the company and there's a lot of properties, and that is why the number is so big. Okay. Bless you. So tips and reminders for file reviews. Again, read the notification letter. Only provide us what is requested. Use clarification statements when needed. The file that you should submit us should tell a story. We should not have to go wonder how you did what you did. Okay? If we have to start wondering how you did or why you did what you did, there's probably going to be a lot of findings. There's probably going to be a lot of findings. If you have questions or need clarification on something, every one of the compliance monitors will be happy to answer your questions. We would rather you get it right than wrong later, okay? Every one of them would like to not do a final report and send clean audit letters. It makes our jobs a whole lot easier, okay? So what to do in your 14-day window? Develop a plan, check your work, have somebody else check your work. Do more work on the front end than on the back end, okay? These are our physical inspection findings. These are the top 10. This is a mix of Inspire and state non-compliance. They are not separate lists. This is a single combined list. The number one thing that we wrote up, which was still under a grace period last year, so I suspect that this number goes down significantly this year. And if it doesn't, we got bigger problems. But that is that unprotected GFI within 6 feet of a water source. This was, again, a grace period. We it was a big expense, a big change from the UPCS to Inspire. The second thing that was written up the most was that TPR valve, that TPR pipe, not having that 2 to 6 inch airspace. I don't know why this was written up so much, because the grace period was over. Grace period ended in 2024. So all of those 1,300 that were written up were non-compliance. And the one that still blows me away, and I don't understand it, is number 3. Y'all, 615 units. Mind you, these are the only ones that we actually went to. This doesn't count the properties that we didn't inspect last year. These are only the properties that we went to. 615 units across the state have been vacant for more than 6 months. My opinion, that is not okay. There is not enough affordable housing for there to be 615 vacant units over 6 months. Some of those have been vacant for several years. If you can figure out, the question is, what is the reason? And I'm about to say, if you can figure out the reason, then that would be great. Poor management a lot of times, just not renting your apartments. On the rare occasion, it is lack of funding to be able to get the units ready, but that is such a small percentage. The biggest percentage is your site staff not filling the units, period. The biggest unit, the biggest reason, and I hear it a lot, and this goes back to swapping unit status. You don't know how many times I heard, well, it's on the 3rd floor and it's a 30% unit. I don't care. I don't know why you are leaving a 30% unit on the 3rd floor. You didn't have a first floor unit that you could have made a 30% unit? Like, it doesn't have to, your units have to float. Your statuses have to float. That 30% unit on the 3rd floor doesn't always have to stay a 30% unit, right? If you can't rent a 30% unit on a family property on the 3rd floor for 2 years, then something's wrong. It doesn't get to stay vacant just because it's a 30% unit and a 3rd floor. So most of these 615 units are vacant for more than 16 months because the site staff aren't renting the units. Okay. So smoke alarms not being installed where they're supposed to. A lot of this has to do with them being too close to the HVAC vents or not being in all of the bedrooms with the new Inspire rules, some of those older properties. Too close to the walls. Yep. Too close to the walls, too close to the air vents. And some of them right up under the ceiling fans. Yep. Well, they installed a ceiling fan in a building in a bedroom that didn't used to have a ceiling fan. The call for aids being blocked or the pull cords being too high. Generally that's because they're still tied up. You didn't ever undo them from construction. Egress, the windows being blocked, doors being, they're not latching. The sink stoppers missing, electrical outlets, exposed electrical outlet. These are your HVAC that aren't tied off, and we inspected them and they're now exposed. Or lots of non-inspectable areas. A lot of times this is the storage units that y'all forgot to check to make sure you had the keys for when you switched the locks on a vacant unit. You didn't make sure that the storage unit key matched, or you switched keys and you forgot to grab the storage unit keys, or you pulled out that keychain with 20 keys on it because you never took the old keys off of the key tag when you put the new keys on the key tag. I would say at least 75% of that 340 is storage units. Okay. Yes, ma'am. So the question is if those non-inspectable areas are including, like if we knocked on somebody's door and they were sick, and the answer is no. We didn't inspect that unit, and it wouldn't be, we would have just picked an alternate unit. We know things happen. People come to the door hacking and coughing and I got a fever. Sorry, I'm just going to go to your neighbor and I'm just going to knock on another door that somebody's home, right? Because we also are not going to let you go get the keys to another unit. We will sometimes, but sometimes it's just literally knock on the door and see who's home, and we'll pick another unit that way. But no, those non-inspectable areas don't include the people who answered the door hacking up alone. But overall in 2025, over 18,000 findings. Well, we know 24 pages came from Stephen on one property, but 18,000 findings. Huh?
And it was deserving.
Yes, yes, yes.
I didn't even have to look at the property. I recognized the management company.
Stephen.
Sorry.
Anyways, 18,000 findings in 2025. Y'all, that is a lot. I don't know. I didn't pull those numbers. She asked what 2024 was. I didn't pull the numbers for 2024. I only pulled the numbers for 2025. So, yeah. 18,000 findings. And that's just for the physical. We're not even talking files. We're just talking physical. Yes, sir. Yes, sir.
Like to have a show of hands.
They can
It-
see the hands.
No, they would like for the people in the audience in the room to raise their hands and the people in TV land to send in a response
Oh.
advocating for the full file uploads for move-ins, key events, instead of separately saving, naming, and uploading each individual document for each
Y'all just
file.
raise your hand.
This
It's not
is a
happening.
truly diabolical request.
Okay. So,
Yeah, I can't read the rest
Yep.
of it.
so there are reasons that we have to have, so TV Land wants to be able to upload one document for their files instead of the lease under the lease, the tick under the tick, the assets under the assets, the income under the income. And I can tell you that that is not going to work.
And so our next question is, this is a lease up.
Okay, we got to lease up.
Therefore,
Say that
we-
again. Hold on.
question is for lease up. Therefore, we have not had our physical inspection yet.
Okay.
My question is about the GFI. The builder did not install GFIs in the laundry room. However, the breaker is in the GFI. Is that okay?
As long as that outlet that is within 6 feet of a water source is protected, whether that is the GFI, it like the outlet itself is a GFI or the breaker is protected and will trip. The whole purpose is if water gets in that outlet, that the power gets shut off. So whether it's just the outlet that has the tester buttons that you can turn on and off, or whether it is tied to the breaker that's a GFCI that will trip as a whole, and the breaker itself has tripped, that you can go reset. And the only difference is if it's the one outlet that is being used by a major appliance like a washing machine or a refrigerator, you can change it to a single source outlet where it's just one outlet instead of the duplicate normal outlet, so that nothing else can be plugged into that but the appliance. But as long as the breaker itself will trip when water gets in there, you are fine.
Fire tester.
Correct. So Steven said all of the inspectors carry a GFI tester, and those are really great because you plug them in and you push the button. If it doesn't pop it, it's not protected, period. It'll still show power. All right. 18,000 findings. That's a lot. So what are we looking for? We're making sure that they are in compliance with Inspire, with the IRS and state specific requirements. We give you a sheet with every notification letter. It's in your book. It's on the website that tells you what the state specific and the IRS stuff is that's not included in Inspire. Compliance tips, have a preventative maintenance schedule. Honestly, Inspire only gives you 14 days for an inspection. We give you 30 to 60. But truthfully, I should be able to say, I'm coming tomorrow and you should be able to be ready. Okay, your preventative schedule, you should not be waiting for me to say, hey, I'm coming for you to get your property ready. You should say, great, see you tomorrow. That's the way that it should be. So walk in your property on a regular basis. I should not be the one that tells you what I find at your property. I know that you guys have probably heard this before. I did an inspection at a property. I had never been there before. Manager had been there for over a year. I walked behind the building and said, hey, what's that? She goes, I don't know. Dog park that the property owned. It's her property. She'd been there for a year. How many times do you think she walked behind the buildings? And it wasn't even behind the buildings. It was between two buildings. But you couldn't see it from the road. Do you think that's a problem? Do you think they did very well on their inspection? They did not. They may have had 24 pages worth of findings. When the staff is in the units, everybody should be looking for work. Your maintenance man should actually be creating more work orders than you do on your inspections. Okay. budget properly for replacements and big repairs. Deferred maintenance costs a whole lot more later. We have an inspector that did an inspection last year. Parking lot hadn't been seal coated and striped, and I don't even want to know how long. But they put off the $6,000 seal coat of the parking lot. Guess how much they have to pay now? $100,000. Why? They have to rip up the whole parking lot and re-pour it. So $6,000 every 3 to 5 to 7 years, depending on the parking lot, right? We know some of them can go a little bit longer. I would have much rather paid $5,000 every 3-5 years than $100 to now get the parking lot back in order. So deferred maintenance costs a whole lot more later. So budget. Notify the staff when you get your rough schedule. Your maintenance staff and your site staff should know in January that we're coming in July. What happens when your fire extinguishers are due July 1st? They need to have that already scheduled, right? We're not waiting to the day before to because everybody's backed up. You might not even get on the schedule. If you wait till we notify you that we're coming to get all of your stuff that's due right there, guess what's on back order? Your fire stops. You didn't get them in time. Now you're in non-compliance. If your site staff knows that we're coming in July, in January, they're working January to July to get ready, right? They're working on those big things. They're working on all that stuff. Don't wait till you get the notification letter. And then when you do get the notification letter, make sure everybody has it. They know what we're looking for. Inspection day, making sure that the affirmative fair housing marketing plan is updated in our CRS, making sure that it's posted on the bulletin board, making sure it's also accessible on the bulletin board. Tenant selection plan the same. The violence against women, the emergency transfer is the same. If you're a Chodo property, you got to do all that as well. On inspection day, you want to make sure you've already made sure that everything was inspected. For inspection day, we need the reports. We do not want to roll up on the site and say, hey, can I have your sprinkler? Well, I don't have them. It's non-compliance and avoidable non-compliance at that. If there were findings or your backflows failed and you had to get them serviced, make sure you have the documentation that they passed and all of the information that you got everything done. Helpful hints. If the reports are not available before the inspector leaves the property, it will be recorded as non-compliance. Everything has to have been passed inspection within the last 12 months. We need those backflows to say passed. We need the inspection reports to say that they passed. Also inspection day, when we're choosing the units, we're going to do the sample size that we talked about earlier. Our vacant units in 2026, we're still going to go up to 20% of those vacant units that have been vacant over 30 days. Prior to 2021, we inspected all vacant units over 30 days. But as of right now, we're still only doing 20%. We will go into all vacant units that are over 6 months. Okay. Whether they're ready or not. I want to see why they're vacant for more than 6 months. We can and have inspected 100% of the property. Even though we may only say that we're doing 20% or 10%, we have done 100% file reviews and 100% unit inspections. We are not going to choose units that are infested with any kind of bugs. I ain't taking them home. Residents that are under eviction, and we're not talking that you just sent them their late notice that they didn't pay their rent. You need to have actually filed the court papers for that to be considered under eviction. Now, if they're a hostile tenant and you sent them their 30-day lease termination, that's fine, but we're not talking it is the 7th of the month and you just sent them their 30-day, they didn't pay their rent notice. When I've been to a property and they listed off 15 under evictions, they only had 30 units. I'm sorry, all your people didn't pay your rent. I'm not talking about your people who pay their rent every month late. Actual evictions. Obviously, if you filed the writ, contagious illness or terminal illness, Me personally, I also didn't go in if you just had a brand new baby that you just brought home from the hospital. There are some life events that we just don't want to interrupt. If you know your residents and you know those things are happening, when we ask you about sick and things like that, you're going to say, hey, Jane just had a baby and just came home from the hospital yesterday. Great. I'm not going to bother her. Okay. Or, hey, Michael's on hospice and has somebody coming in every day. Great. I'm not going to bother them. Okay. Vicious dogs or cats. Residents that are verbally or physically abusive. I ain't taking that abuse today. And minors where the adult is not home. Okay. We are not going into homes where minors are the only people that are home. When we ask you for this list at the very beginning, before we tell you what units we're going into, that is when we want all of this information. You may not know about the minors until we knock on the door, and that is okay. We will again pick an alternate unit, just like the person who came to the door coughing and hacking with a high fever. We'll pick another unit. However, most of our compliance staff, if we give you the list of the 10 units that we're going to go into, when we see that face that you make, when we said we're going to go into 101F and we saw the face and you're like, I forgot to tell you they're sick. Guess what we're doing? We're going in. We're going in. We're going in. Because what did you just do? You just don't want us to go in there for whatever reason. We're going to go find out. Responding, file reviews, make sure everything that is included. Don't backdate corrections. Don't use true and accurate. It doesn't mean anything. Comments and concerns don't require a response, but you should address to those so that you are preventing non-compliance things in the future. We cite compliant or concerns and comments both on files and physicals when we notice that your practices may not be the strongest and we're trying to give you tips on how to be better. So if you're looking at those and you're addressing those issues, you will become better. Yes, ma'am. Correct. So, yep. So what Lisa is referring to is there are times, especially on a file review, I don't think there's any times that it happens on a physical inspection, but on a file review, if we've sent you your compliance results letter and the only non-compliance items that are listed show corrected, this is because you didn't upload the files within 30 days and we had to put you in non-compliance, but it's corrected non-compliance because obviously you uploaded the files. You still have to respond to that compliance results letter. If you don't hit the button, we don't know that you've reviewed the letter. If you have the action step in your system, you have to do something for the system to notify the agency that you're done doing what you need to do. Okay? So even if there isn't anything to correct, you still have to hit the submit button. I have a question for my management friend back here. Did you have to upload something? Or can you hit, Okay, so she just did it yesterday, and that's why I was putting Rebecca on the spot for a second, is you have to upload a document, but it could be a simple, I reviewed the letter and I agree, or I'm gonna do better next time. Okay, yes.
That is in the system like that is used to when we were doing the agency report cards. That's where they pull that information from to run the numbers was from the letters that we did, physical inspections and file reviews. So we had to make it non-compliance in order for it. That has changed. We now run the report through RCRS and not based on the findings that we cite. So my question is to Tanya and Randa, can you take it back to the team leaders and to leadership that we can start making that a comment instead of non-compliance?
It still won't pull in the non-compliance.
But it doesn't pull from that letter, does it?
It still pulls from the fact that it is a non-compliance and not a concern.
Oh,
Yep. Good try.
well, I tried. I'm sorry,
Good try.
folks. I did my best. I feel your pain because it's a step that I have
It
to,
is. And
you know, the
nobody
management
likes
company
it.
has to go through the process of completing it. We have to go through the process
Y'all
of
wanna
moving
know how to
on.
fix it. Upload your stuff within 30 days and we won't have to cite it.
So we don't do that for the joy of it. We're in the
But
same boat as you.
it is not something that any of us like to do. However, in order for those letters
I
to
tried.
flow
Sorry.
through properly, in order for us to know that you have reviewed, think of it like this. What if we got it wrong? What if we calculated wrong and you uploaded it on day 29? Right? And you could easily respond back and say, hey, nuh-uh, I was in there on day 29. Calculate again. Now we have to clear it. And it's not actually a finding that's corrected. So we are giving you the opportunity to now check our work to make sure that we were right. We just need you to know, we just need to know when you're done. So you have to hit the submit button. Anything in RCRS that is living on your side, this goes to rents, reserves, letters. If you have the ability to change it, that means it's living on your side of the system. We can't do anything and don't know that to do anything with it until you push the submit button, the okay, I agree button, the whatever, for it to then get kicked back to live on our side of the system. Make sense? Yes, Stephen.
This is an actual question
Oh.
for TV Land. If the property has over 120 vacant units that have mostly been open or over 6 months, will you inspect 100% of the vacant units?
This is not a real life
Especially
situation.
when it is a re-inspection due to the recent failed inspection? Also, does that need to be taken into account for scheduling, as that would include any occupier?
Okay, so the answer is if you got 120 vacant units over 6 months, we may very well decide to do a 100% unit inspection at that property. We might be looking deeper into the management company. We might be doing a lot of things, but we can go into every single one of those units. Does that answer the question? I'm not saying that we will, but we can.
Hope it's not one I'm scheduled for.
It's gonna be a lot longer than 24 pages. But every one of those units is out of compliance. Whether we go into them or not, whether we go into a vacant unit that has been vacant over 6 months or not, if this was a legit, there is no valid way that we are gonna go into 120 units in 1 or 2 days. But every single one of those units is out of compliance and will be written up for non-compliance, whether I step foot in that unit or not. It is out of compliance because it has been vacant for over 6 months.
My friend has a question in TV Land. If there is an agency error on non-compliance, if our syndicator questions this, can we request confirmation from the agency monitor that it was an agency error?
You can request whatever you would like.
But the clear findings should address that was
Correct.
an area that there is no
Correct.
issue.
So if it is an agency error and if it is an error and not supposed to be something that is non-compliance, or you have forgotten to upload something originally, you supplied it, it was clearly in the file before. If you see the word cleared, nothing was reported to anybody. We cannot delete the finding. We have to have record that it is there and that it was there. If you see the word cleared, it is not anything that is reported to the IRS. It is not a finding that is found anywhere. Uncorrected and corrected mean that there is a legitimate finding and it was corrected or not. But if you need something for a syndicator and you are thinking that it is not clear as mud, that it's already there, then you can request whatever you need and we will take that request individually. Physical inspections, failure to make the 24-hour repairs within 24 hours. Again, you are not sending this separately. You are waiting until everything is completed, sending it together. But our inspectors do know how to look at dates. to know whether it's happened in 24 hours or not. And they are making notes on the inspections if it was not made within the 24 hours. If we start seeing that people are not doing it within 24 hours widespread, we will adjust how we are looking, and we may require that 24-hour, just like HUD does. Okay, so please don't make us do that. Please. So provide a work order invoice picture. Your inspector will note if they want something specifically. Generally speaking, an invoice works just fine if it was a contractor and you paid somebody to do the work. You're going to use a work order if somebody in your office, your management company, did the work. And you're going to provide a picture if the resident did the work. Okay. Making sure that any documentation that you provide includes the date that the work was completed. Otherwise, it's considered incomplete. And again, making sure that your work order doesn't just say done, because we don't know what you did. If you've got 5 things listed on there and maintenance just said done, that is not a valid work order. That is not a valid work order. Not just for us, but what happens when your tenant calls and complains that maintenance didn't do anything? You got nothing to back up what maintenance did when they were in that apartment. All he said was he's done. I don't know what he did. Did he go to the bathroom? Did he eat lunch? Did he fix the stuff? He's just done. So, words. If you submit a bid or a proposal or a order sheet that you ordered something, does that correct the non-compliance? It does not. And we don't need a copy of the compliance results letter. Believe it or not, we have it. Responding, you're going to receive the compliance results letter. You typically have 30 days to respond. If you've got big ticket items that are going to take longer than 30 days, you can ask for an extension. We are nice. We do allow them sometimes. Final report or final results letter, the 15-day grace period is gone. The final letter is the final letter. Anything open after the final letter, you have to do a compliance results or a compliance resolution packet. Those compliance resolution packet, again, they do not show up in that lovely red dot. Nothing in the system is going to tell you that you have open non-compliance. This is your responsibility to track. I think I said yesterday, or maybe it was this morning, I don't remember. If you can create a compliance resolution packet, you have open non-compliance. If you can't, you don't. That's an easy way to track it. Trainings, just overall registration for our classes. Everything is listed on our website of what trainings are available for the year. Registration for classes closes 2 Thursdays before the week of training. Please understand the cancellation policy because we are pretty strict on it. We have recorded training videos on our YouTube that kind of help you walk through some RCRS stuff, some compliance stuff. The recordings from yesterday and today will be posted on there as well for the year. These are our trainings for the year for both Compliance 101 and Advanced Compliance, our key and targeting, our supportive housing. Our training material, again, we listed on our website. This book within the next week will be posted on the website. And also, I think there are a couple extra of today's books in the back that please take home. I don't want to throw them in the trash can. So there's a couple extra back there. Fair housing. This is a big one, y'all. Do you know that the agency offers free fair housing training? Free. 100% for free. Both small ones. Lamar, you got anything to say about the fair housing training? You and Frederica do an amazing job. Uh-huh. Yep. The community living. Yep. But you guys offer mini ones, and aren't there mini classes as well? The virtual ones, there's small ones as well as the big all day one. Yeah, specialized, there's the word I was looking for. There's specialized fair housing ones and like full fair housing trainings. At least once a year. And Frederica and Lamar both do that in conjunction with legal aid, right? Yep. You have a question? All right, give me one. Y'all, I know that you guys are ready to go, but virtual land and the people in the room can't hear the last of the questions. So just give us a couple more minutes. Y'all, it's not even 3:30 yet. Come on. Uh-huh.
This specific training, is it any? Yeah, so is there any way to kind of like teach you maybe not have? We have like training is small, you don't have any in the school. So if you don't get in, you have to. Okay.
So you'll add more dates in the future? Okay, perfect. Your schedule for the fair housing is not loaded. So for compliance training, for DHHS training, for supportive housing, in January, everything for the year is listed. For the fair housing, they list the first half of the year, and then they will list the second half of the year. They do not list the entire year at one time. Yes. So it is not a full year. So if you missed the first half, look for the second half. Okay. Any questions? Are we good in the virtual world?
Certificates be available.
Okay. As we said, I got a question to answer. As it was stated in the very beginning, you will get your survey within 7 days. If you do not complete your survey, you will not get your certificate. Thank you. Thank you, Lamar. If you've opted out of the emails, you won't get the survey and you won't ever get your certificate. Any other questions in the virtual world? I gotta stop asking.
The fair housing training, do they get a certificate? And when will they get that?
All of NCHFA training, it doesn't matter whether it is with legal aid and Lamar's team or whether it is in the compliant asset management team. If you opt out of CVent emails, you will not get your survey. If you do not complete your survey, you will not get your certificate. Okay. Thank you. You have a question. Okay. We got a question. It did, and everybody was automatically put to the, so the question is, she was attending the virtual DHHS training that happened in March. Here, there was no internet. Everybody was automatically moved, but you could opt to a different if you wanted to. I don't know.
22, because 10/29 is the North Carolina Affordable Housing Conference. So we
Okay,
had
so
to change the dates
likely 10/22, and I made an error. So, yep.
because they had
So-
to go back and reschedule.
Listed on our website as well when you go to register. And if you got the email then, and it says 10/22, then that's the right date. So the next DHHS virtual is 10/22. Yes, virtual land or Stephen?
Dorian.
Oh,
Dorian would like to remind everyone that you need that fair housing certificate to include with the affirmative fair housing marketing plan documentation.
all right. Any other questions? Are we good? Thank you, everybody. Staff will be here for a few more minutes if you guys have extra specific questions.